Hey guys, so we're gonna start this trading course, but before we do, there's a few things I want to tell you which are very important, okay? So first of all, I'm gonna be teaching you how to day trade, swing trade, and even invest because everything I teach you will apply to everything, okay? Now, it doesn't matter what you trade, if you want to trade stocks, forex, crypto, indices. I personally trade every single thing. My method is a little unique compared to other people. Other people will teach you how to trade gold or silver or stocks, but my mindset is that I will look at every single thing, and whatever gives me the best chance of winning, that's what I'm going to enter a trade on because the markets are already really competitive and it's really hard to find a good trade because of it. And that's why I like to look at as many things as possible because then I have a higher chance of finding a good trade. It's like imagine you're digging for gold, but you only have like little bit of room to dig. You're gonna have to dig really deep, and you're gonna dig for a long time to find gold. Versus you have a whole mine, a whole bunch of space to dig for gold. Now you're gonna find more gold. So it's the same concept. So I'm gonna be teaching you how to trade everything. It works on every time frame. Yeah, there's pros and cons on different time frames, but at the end of the day, you're gonna learn these pros and cons, and you're gonna be able to trade on every time frame and anything that has a chart, even if it's something like water, anything, okay? Now, another really important thing I wanted to tell you guys is you should only have one strategy and one mentor. Now, technically, my strategy does consist of different factors, and sometimes we use different factors and we use it differently in different scenarios, which you'll learn all about. But what I'm trying to say is you don't want to learn too many different things like, oh, let me get into AI trading, let me get into this trading or that trading. You might be thinking like, oh, if I'm doing that, I'm more likely to find what works. But the truth is, if you're doing everything, you won't be able to spend enough time on them individually to know if it really works or not, or if it even works or not for you particularly. So that's why the best thing to do is to pick one strategy, one mentor, and just make sure the strategy works and that the mentor is profitable. Whether it's me or anyone else, doesn't matter. I'm sure there's a lot of other profitable traders too. If you chose me, stick to me. If you haven't chosen me yet, really, find that one person who you know is profitable. And the only way to know, in my opinion, is to copy their trades for a couple of months or a year or longer. And if it works, then learn from them. That's the best method. Because if you copy their trades for a month or a year, whatever, you know it works, you know how much money it makes, you know all the details. And now you're actually going to be motivated to learn from them because you're like, wow, I've made money copying this trader for a year straight, so he's consistent. 1 month doesn't mean anything. Even a month doesn't mean anything. Yes, you could get lucky. So if you're consistently making money from copying someone, now you know that you're not going to waste your time by learning that strategy, okay? And you're actually going to be motivated because you're going to be like, okay, I've made money copying him. Let me actually learn this so that if something happens to him, God forbid, he stops sending out alerts or who knows, maybe he just passes away. Anything can happen. Hope for the best, but prepare for the worst. Now you're able to do this alone without his help. So that's how I personally went about it, right? I've learned institutional factors from institutional traders, but I only learned from them and I was only motivated enough to learn from them when I was actually making money from just copying them. Now, another thing is, if you are going to learn from me, whether you're a brand new beginner or maybe you've learned from other people, didn't work out, and now you're coming to me, look, it's okay to have your own opinion at a certain point. But right now, if something doesn't make sense to you and you're thinking, oh, why does he do it this way? I'm just going to do it this way because I think it's better. It makes more sense. Look, you can do all that once you learn everything and have experience. Until you reach that point, it's just complete arrogance. And I'm telling you this because I want you to succeed. Like, I've made this mistake too. When I was learning from institutional traders, I'm like, I love the way this guy trades, but this one small thing I'm going to do differently because I know that this is just better. But then at some point I'm like, wow, I should just listen to him. Now I realized why he does this. It didn't make sense to me. I thought it was a complete, made no sense. The move made absolutely no sense. But it really just comes down to experience and knowledge. Just because something doesn't make sense now doesn't mean it won't later. Okay? I'll give you one example. I'm not a big fan of prop firms, and a lot of people look at me like I'm crazy. And I use certain tools like the RSI, and a lot of people look at me like I'm crazy. Like, that's a retail tool. The RSI, yeah, you're a complete noob, you're a complete beginner, you're a complete trash. But it's not about what you use, it's about how you use it. And these same people that look at me like I'm crazy, once they actually learn everything, they realize why I like certain things and I don't like certain things, and why I use certain things that most people would consider me crazy for using. So you can have your own opinion, you can do things your way, but once you earn it, and you earn it with experience and time and just knowledge. But anyways, if you chose me to be your mentor, I hope you're excited for this course, because I'm going to teach you everything from the very beginning till the very, very end. And if you need any help, let's say I teach you a lesson, there's something you don't get, we're going to have a phone number that you can call in the link in the description of this video or whatever course. There's going to be a phone number. Maybe it's going to pop out right now, right here. But you can call that number or reach out in other ways. There's going to be other ways of reaching out for support if there's something you don't understand, because we want to make sure you actually get everything. I'm going to do my best to make this as beginner friendly so that everyone can understand. I'm going to try to be very, very careful in what I teach and what sequence I teach it in, so you don't get confused. But if you do ever get confused or something doesn't make sense, you got to understand that, that's part of any high income skill, and you have to overcome it. You don't just give up, you find a solution, and the solution is to reach out for help. One last thing I forgot to mention about why you should only have one mentor and one strategy. There's a lot of people, this doesn't just apply to trading, this applies to life in general. There's a lot of people, I've personally seen a lot of people doing a lot of different things. So I want to do this, I want to do that, I want to do this, I want to trade, I want to do construction, and they think, for some reason they're proud of it, and for some reason they think that they're going to succeed. And they might succeed, but you got to understand, majority of people aren't Elon Musk. I'm not Elon Musk. I'm not like Elon Musk. You got to understand, people like Elon Musk that do a million different things and succeed at all of them are God gifted. They have the best genetics. That's just the reality of the situation. They don't have our type of brain. For a majority of people, the best thing you can do is pick one thing and just stick to it and not give up. What people like to do, even when it comes to businesses, is, oh, that business looks really easy. I'm doing all this. It's hard. That business looks really easy. Let me do what they're doing. And when they actually do it, then they find out the hard parts of that business. Because if everything was easy, right? If there was a business that was truly just easy in every way, then everyone would do it and eventually it would stop working. So there are issues with every business. There's going to be issues with this business. So pick one business, stick to it, pick one mentor, pick one strategy, and you'll have the best chances of succeeding. But just make sure whatever you pick, you do your research and you make sure that it works. Okay, whether it's a business or whether you're learning from someone or a strategy, make sure it works. And the best way, again, is to copy their trades for a year and seeing for yourself if it works. But anyways, I really hope you guys are ready for this course. I want you to lock in, get your notes ready, everything. I don't care if you're a brand new beginner. I don't care if you don't know anything. I will make sure that by completing this course, you go from a beginner who knows absolutely nothing, you don't even know what trading is maybe, to someone that can consistently make money. Okay, so hope you guys are ready. I will see you guys in the first video. You guys take care. See you later. So what is trading and how do you make money from trading? So I'm sure you've all heard of things like commodities, like, gold, silver, oil, natural gas, and there's cryptocurrencies like Bitcoin, Ethereum, Solana, XRP, and then of course there are stocks like Tesla, Apple, Google, and Microsoft. Now, all of these things I just mentioned, they all have a dollar value, just like anything else in the world. Okay, for example, maybe you have a water bottle and it's worth like 20-30 bucks. Your laptop could be worth 500 to 1,000. Well, all these things also have a dollar value, but here's the thing. the value of the things that I mentioned is not constant. So it's not fixed. The price or the value of those things is always fluctuating. It's going up and down in value every single day, all the time. And our job as traders is to take advantage of that fluctuation. So we want to buy when the price is low, and we want to sell when the price is high. And as you guys can see here, the price goes up and down all the time, right? So there's a lot of opportunity to make a lot of money. So that's what trading is, and that's what we're going to be doing. And I hope you guys are ready to learn how to make money. So other than stocks, crypto, indices, commodities, futures, there are also forex, so currency pairs. This is like the euro dollar and the US dollar. You know, their value does also fluctuate. So when you put them against each other, you get a chart that looks like this, and this is going to move up and down. So you're basically betting in favor and against a certain dollar paired up with each other. So people also trade this by looking at the charts, and near the end of the course, I will teach you guys a very special strategy that only works for Forex. Okay guys, so this is a charting software. It's called TradingView, and I'm going to be teaching you guys how to use the free version, okay? So a lot of people first of all think that you need to pay for TradingView, but the thing is, when you search up tradingview.com, as long as you're signed in through your Gmail, you don't need to pay for anything. Okay, so it's free. Of course, there is a paid version if you want to upgrade, but that's like in the future, you know. Anyways, so I'm gonna go over how to use this. Again, this is a software to look at the charts and then figure out where the price is gonna go. So we don't actually do any of the trading here, right? I'm not gonna buy or sell here. This is just used to figure out where the price is gonna go, so you know if you're supposed to buy right now or sell, right? Now, we're gonna start off with this over here, and we're gonna go in a circle like that, okay? So this here, it says BTC. You can literally search up whatever you want. Maybe you want to look at gold, right? And yeah, it's up to you what you want to look at. You just search it up here, the symbol, okay? Maybe you want to look at Tesla, right? So yeah, pretty simple. Anyways, then you have the time frames over here. So I have the 1 minute, 15 minute, 1 hour, day, week. Now you can add more time frames by pressing on this arrow, and there's a bunch of options, right? You can add a custom interval as well, so minutes and how many, or maybe you want to do hours. So make your own time frame here if that's what you want to do, and then it'll show up here, and then you can star the ones that you like. I personally like the 1 minute, 15, 1 hour, day, week, and month, right? So they're all here. Where's the 1 month, as a matter of fact? Right here. There we go. And now you see the 1 month just came up here. And you can unstar them and they'll disappear from here. And then you have this, and you can select what type of chart you want to use, right? I stick with candles, and then indicators here, so whatever indicator you want to use, you can use, right? And you can star the ones that you like. So maybe you like moving average, cross, you can star it so that it'll show up over here, okay? And then you have alerts, so that basically means, let's say you click here, you can so you can write down that, you know, if the price, you can set up an alert, like maybe if the price hits a certain value, you want to be alerted, and you want to be alerted through notification via app, via email if you want to turn that on, and you can write down the name of the alert and the message, okay? And there's another way to do it, I'll teach you in a bit. Replay mode, right? So you can back test, and then you can play it here. You can increase the speed, you can play it here, and if you ever want to, and you can buy, sell as a back test. So maybe you want to sell short, or maybe you want to buy, and then it'll tell you, you know, it'll tell you if you're up or down and stuff like that, okay? Anyways, There's that. And then over here, you can move this to the side. You can change it, like maybe you want to have 2 charts on one screen. Maybe you want to have 4. You can do all of that, but you need to pay for that. Okay, and then you have the watch list. So we'll talk about these. So the first thing you have here is the watch list. You can have multiple watch lists. You can, create your own watch list, have multiple. If you don't have the paid version, you can only have one. Okay, to add things to the watch list, you just you just search it up. So you press the plus sign, and then you search up whatever you want, and you can add it. And if you want to delete it, you can just press X. If you want to move throughout the charts, you can just, and it's good to have a watch list. Have a list of everything you are keeping a close eye out on, right? And this here are your alerts. So I have 0 alerts right now, but I'll create one in a bit. Okay, and this stuff doesn't really matter. None of this stuff matters. So now we're going to get into this stuff here. Okay. Now, really quick, before we get into this stuff over here, I do want to say, so let's just reset, right? Right click, reset. This is what the chart looks like. I can move it left, right. I can't move it up or down. If I zoom out, if I want to zoom out, I gotta do, sorry, not that. I gotta like use the roller on my mouse, right? And I still can't move this up or down. And if you guys want to do that, all you gotta do is move this stuff here just a little bit. And now I can go like this. Now it gives me permission to do whatever I want. And if I want to reset, I can always reset, and it's back to normal. Okay, and now I can't move this up and down anymore either. But if I do this, click just a little up or down like that, now I can do that. Okay, so you want to practice moving the stuff around and getting used to it. And in the background it says Bitcoin, what time frame I'm on, and what Bitcoin USD, right? So the ticker, time frame, and description. You can right click settings, and I believe it was, hold on. So right click settings. There's a way to turn it off. Hold on. I don't know why I can't find it. That's kind of weird. There is a way to turn it off though. Okay. Oh, there we go. Yeah, so you go to canvas, and then you go to watermark, and then you can just see that, delete those or turn them on. It's up to you. And now it's off because I turned it off. Okay, so again, settings, canvas, and then it's right here under watermark. Okay, and then you have, yeah, so that's basically it. Now let's go over this. This is just what type of, what you want. I just stick with cross. You could do dot. You could do whatever you want. And then you have the trend lines here, right? You have the trend line. You can move it around, right? And maybe you want to just draw a trend like that, whatever it might be, okay? And then you have array, and this is like the same thing, but it just infinitely doesn't end, right? Sometimes this might be more convenient, sometimes the other one. And then you have the horizontal line. Now, I can always click and change the type of line, the color, and the size of the line if I want. I like to stick to 2, okay? And then you have the horizontal array. And I like to use the horizontal array a lot, actually. Okay, so that's that. Now, I want to show you guys something cool. So let's say I want to buy if this thing drops here to the support level, right? So what I can do is I can click on this, and I can click here to add an alert, and now I can call it whatever I want, and notification via email, whatever, and then I can press create, and the alert will be set up. Okay, so it failed for me because of, I don't have premium, that's why. But normally when you set up an alert, it does work, okay? If you have premium. Now, going back here, so there's some other Fibonacci types of tools here. You have the long visual representation right here, right long. You can move this up or down. You have the short. You have markers here, so like a brush, highlighter, arrow, rectangle, shapes, all that. You have emojis too, I guess, which I never really use, but and then you have a measurement tool. This is pretty handy if you want to ever measure, like, okay, I want to buy here and sell here. Okay, that's about an 18% move. It tells you, you know, all that information, right? So you guys could use that too. And that pretty much covers everything. Okay, that's how you guys use TradingView. That pretty much covers it all. And yes, there are some tools that you can't use, like, of course, setting up an alert, right? You now need premium for this, so, but most of it is pretty much free, okay? So yeah, that covers TradingView. I'll see you guys in the next video. Okay, so price terminology, these are the terms you guys want to get familiar with, so let's go over them. The spot price is the current price, right? Whatever the price is right now is the spot price. The order book is all the buy and sell orders that are open. So the moment you want to buy something, maybe 100 shares of Tesla, it's going to go on to the order book. And if someone wants to sell you 100 shares, then your order will get executed. Then you have the bid price, and that's the price that you can buy at right now. Okay? And the ask price is the price that you can sell at right now. And the spread is the difference between the bid and the ask price. Okay? So when you look at the charts, you see there's one price. But if you try to buy this, you're going to buy this slightly higher. If you try to sell it, you're going to sell it slightly lower than the current price. So you're always getting kind of, you could call it a bad deal, but that's just the spread. Okay? Now there's something called raw spread, and that's the real spread. And then there's something called spread. That's basically the spread plus whatever the broker wants to add on top to make their money. So you can think of spread as a fee. Okay, the lower your spread, the better. There's a lot of brokers that have a very massive spread, and that's simply because it's like a transaction fee to them, right? So that pretty much covers all these terms. I'll see you guys in the next video. Okay guys, let's go over what all of this stuff is. So first of all, long position. So in trading, long position is simply when you want to buy something and then sell it. So in simpler words, you can just call it buying, right? So I'll give you an example. So you can see this green line here. This is the current price in the middle, right? If I think that the price is going to go up, I'm going to buy it. Well, that basically means I want to enter a long position. It's just the term we use in trading, right? So this is something you want to get yourself familiarized with, because we are going to use this term a lot. So if I go to my tools here and I go to the fifth one, 1, 2, 3, 4, 5, arrow, it's going to say long position. And then I'm going to click on that and click at the current price, which is the green line. And this is going to pop up. And it's going to be green above and red below the entry, which is right here. And that's because when you enter a long position, which is when you buy, right? So when you buy something, it's green above because you make money if the price goes up, and if it goes down, you lose money, right? Now, you can set these green and red boxes wherever you want, as you can see. And these are really important to understand. Okay, so some people are going to do this. Some people are going to do this. Some people are going to do this. You know, you can set these wherever you want. And we'll get into that more later. Right now, I just want to explain what these are. So these are parameters. The red one is called a stop loss parameter. Stop loss. And the green one is called a take profit parameter. You can call it parameter, you can call it level, it doesn't matter. And what this means is, you know, once you've entered your trade and you've set your parameters up here, for example, let's say the price starts to fall, you're losing money. But if the price hits your stop loss parameter right over here, it's going to automatically sell for a loss. And if the price keeps falling more after, you wouldn't have to worry about losing any more money, okay? Because it automatically sold here for you, even if you're asleep. And then your take profit parameter. So if the price hits your take profit parameter, it's going to automatically sell for a profit. And the beauty of this is that as a trader, you don't have to look at the charts all day. Once you know where you want to buy / enter a long position, you know where you want to set up your stop loss and take profit, you can go to sleep, come back later to see if you lost or see if you won the trade. And this way you wouldn't be making emotional decisions, right? So that might be a good idea for some people. So now you guys know what a long position is, you know what stop loss and take profit levels are. Now just keep in mind, this is a visual representation of the plan. So I didn't execute anything here. Now I know where I want to enter, which is this price here. I know where I want to have my take profit, which is this green price here, and the stop loss, which is the red price here. I'll teach you guys how to execute this later in the future video, but now you guys understand the concept. So let me explain what a short position is. So if you go back to the 5th tool here, arrow, it's going to say short right under long. And this is going to be red above and green below. That's because when you enter a short position, you make money if the price falls. But if the price goes up, you lose money. And you can also set your parameters wherever you want. So this is going to be the exact opposite of what I taught you here. So a lot of people don't even know this is a thing, but yeah, it is a thing, and you can make money on the way down. Traders do it all the time. So as a trader, it'll never matter to you. You'll never care if the price is going to go up or down, because as long as you know which direction the price is going to go, you have the ability to make money. Okay? So that explains all this. I'll see you guys in the next video. Okay, so live account versus demo account. It's pretty much just real money versus simulation, right? So do I recommend you guys start off with a live account or a demo? Honestly, it's up to you. There's pros and cons to both. At the end of the day, they're both based off the real markets. The only difference is that one is with real money, one is with a simulation account. The fees, the spread, everything else is the same, okay? Now, some people want to start off with a live account because they think that they want to train their psychological mind, their emotions, even if it's a small account, and that's fine. And some people think they just need to work on their strategy, no need to risk real money, they got their emotions intact, so they start off with a demo until they know they're profitable. So you have to make the decision what you start off with, live or demo, depending on what you need to focus more on. Maybe you're good with your emotions, you just got to work on a strategy. Okay, go off with the demo. Maybe you have a good strategy, but your emotions get the best of you. Okay, then maybe you want to start off with a live account, just a small balance though, right? But yeah, that covers what a live and a demo is. I'll see you guys in the next video. Okay, so leverage is when you use the broker's money to make more money. Okay, so you're not using your own money anymore, you're using the broker's money. Most trading brokers will lend you money. If it's an investing broker, then maybe they'll lend you a little bit. But the way it works is that they only lend you the money for when you enter a trade. It's not like they just give you money and they tell you go do whatever you want. It's like maybe you have $100 and you can only afford 1 share of Tesla. So the broker might be like, okay, we'll let you buy 2 shares of Tesla. So that's 2x leverage. So 1 to 2. You have $100, but they're letting you buy $200 worth of Tesla. Okay, and you're only borrowing money for as long as you enter a trade. So as soon as you exit, they're gonna take the money back. Okay. Now, different brokers offer a different amount of leverages. We're gonna talk about that a little bit. But first of all, why do people use leverage, and what do the brokers get from it? So most brokers will charge you swap fees for borrowing money. So it's just interest pretty much, okay? Now, that's how the brokers benefit. And the way you benefit is you make more money, right? Now, leverage isn't necessarily just for making more money. So I'll tell you why traders use leverage. So traders, some trade on the big time frames, the weekly, the monthly, where they're looking for big moves like 30, 40%, maybe 10, 20, 50%, whatever it might be, big moves. But then there's some traders that trade on the 1 hour time frame where they're looking for 4 or 5% moves. And then there's scalp traders that look for sometimes 0.20% moves, 1% move or less. Now, if they're looking for a 1% move, they could put all of their money in, and if they win the trade, they're only going to increase their balance by 1%, right? So that's where leverage comes in handy. When you're looking for small movements, you can use leverage to make bigger amounts, okay? And that's how I personally use leverage too. So the way I use it is, if I'm looking for small moves, I'll use a lot of leverage. If I'm looking for mediocre move, like maybe 10, 15%, I'll use an X amount of leverage, like maybe definitely less leverage than if I was looking for a small move. And if I'm looking for a big move, like a really big 50, 60, 70, 80% move, maybe I'm not going to use leverage at all, or just a very tiny bit. So how much leverage you use should depend on the size of your move and how much you're looking to make in terms of percentage. Now, I'm going to teach you guys how to do all of the calculations for that. There's a calculator. I'm going to teach you guys how to do all of that in the later on, okay? So right now I just wanted to get you guys to understand what leverage is, okay? Now, what types of leverage do brokers offer? It depends on what you're trading. So for Forex, they go 1 to 500, sometimes 1 to 30, sometimes 1 to 50. It depends on broker to broker. For crypto, same thing. Stocks, usually brokers offer less leverage, but there's a lot of regulated brokers that actually do offer more leverage than the typical amount. But anyways, for stocks, it's typically 1 to 2, meaning for every $1 you have, they'll give you $2. You'll be able to trade with $2. Sometimes it's 1 to 1.5 for stocks, and sometimes it's as high as 1 to 3, right? Sometimes even 1 to 5. There's some regulated brokers that even offer 1 to 30, right? And then even 1 to 200, some regulated brokers offer. It just depends on broker to broker. But the reason you typically get less leverage for stocks is because they're very volatile. They move very quickly. But then Forex, like maybe Euro USD, it would be an incredible deal if they even move 1% in a day. So that's why you wouldn't really need to use that much leverage for stocks versus Forex, right? So depends on what you're trading, how much leverage they're going to offer. But again, I'll teach you guys how to do all the calculations. Don't worry about leverage too much. It's really easy to calculate. We'll get into all that stuff later. So with that being said, I'll see you guys in the next video. Okay, so now that you guys know what leverage is, how do you calculate leverage? Like if I want to buy Apple right now, how do I know how much leverage I'm going to use? So that depends on a few factors, right? First of all, what is your balance? So let's just say in this example, my balance, is $100,000, okay? Now, how much do I want to risk per trade? That's the second question. So out of $100,000, let's just say every trade that I lose, how much am I okay with losing? Am I okay with losing 5% per trade, which would be 5K? Am I okay with losing 2K per trade, which 2%, which is 2% of 100,000 is 2K? So I have to make that choice. So how much am I risking? Right? So let's say in this example, I want to risk 5% per trade. Okay, which is actually considered a lot. Most people, I think, do 1 to 2, maybe 3% at most. But in this example, let's say I want to risk 5% per trade. So if my stop loss is hit, I lose 5%. Okay, so and again, 5% of 100,000 is $5,000. So I would lose $5,000. right? If my stop loss is hit. So let's say I want to buy right over here, and I have my stop loss here, or maybe actually over here, okay, right here. And I have my take profit. Doesn't matter. We're not going to calculate how much we're going to make, any of that. We're only worried about our stop loss. Okay, so I have $100,000. I want to risk 5%, which is $5,000. Now, the question is, how much leverage am I going to use? So when you use a trading platform like MetaTrader or whatever broker you have to put in that amount, right? Now, if you're using MetaTrader 4 or 5 and a lot of other platforms, you're going to have to use this particular type of calculator. And I'm going to teach you guys how to use this. So when you put in the leverage, now the area where you actually put in the leverage, it's going to be called lot size. Some platforms even call it volume. Okay. But I'm not going to do volume, so lot size. So the question is, how much lot size / leverage should I use? What number goes in here for me to lose or risk 5%, which is 5K of 100K balance? So how much leverage would I have to use? Well, and again, in this scenario, I'm willing, my stop loss is here at negative 5.69%, as you can see right here, right under my mouse right there. Okay, so this is the price. So what we're going to do is we're going to go to this calculator. Okay, I'll have a link of this in the description of this video. And the first thing we're going to do is the instrument. So in this case, we're trading Apple, right? And what deposit currency are we using? So, oh yeah, I forgot to mention, maybe my balance is 100K USD. Okay, 100K USD. So USD, open price, that you want to put in the price where you want to buy. So I want to buy at this price here, which is 230.23. Let's put that in. And my stop loss is at, let's see, 207.69. Okay, and again, I'm risking 5%, and my balance is 100,000. Right? And you can change it from percent to dollar amount. Maybe you want to do $5,000 or $6,000, or maybe you want to risk a percentage of your portfolio, of your balance. It's up to you. Calculate lot size. So if you're using MetaTrader 4 or MetaTrader 5, there is a way to see what the contract size is of the stock or whatever. Now for stocks on MetaTrader 5, it's going to be 100. Okay, but don't worry, I'll teach you guys how to find this on your broker, like how to know what number to put in here in later on in the videos. Like you'll learn that later. Okay, for now, all you need to know is that if you're using MetaTrader 4, it's going to be 100 for stocks. If it's 10. Okay, but if it's MetaTrader 5, it's going to be 100. Okay, one thing I'm certain about is for MetaTrader 5, it's 100 because I use MetaTrader 5. It's the newest version. Anyways, forget about this. You can just literally check what the contract size is by going on your MetaTrader, click on whatever asset you're looking on, click on details, and then it's going to show you, and I'll show you how to do that later on. Now when you calculate, it's going to say your lot size. Ignore this and this, just right here, 2.21. Okay, cool. So what I'm going to do is I'm going to go ahead and buy Apple, and it's going to ask me how much money do you want to buy with / leverage, whatever. You're just going to put in this number, 2.218. You're going to have to round up, 2.22 actually. And then you buy, you press the buy button, and then you put in the stop loss price, the take profit price, and in case the stop loss does get hit, well, you use the perfect amount of leverage so that you only lose 5% of 100K, so you would lose 5K, okay, if it does get hit. Now, you can see the risk to reward is 2.14 here, 2.14. So let's get a calculator. So if you risked $5,000, times this by 2.14, you would be making 10.5k. Because again, you're risking this much, but look at where your take profit is. If it was a 1-to-1, if it was even, then it's like, okay, you risk 5k, you make 5k, right? So that's how you calculate leverage, guys. It's pretty simple. I'll have a link of this in my bio. You guys can check it out, okay? Okay, so guys, technical analysis is basically looking at the charts, having trend lines, support, resistance, patterns, just looking at the charts. So pretty much anything on this software trading view to figure out, you know, where the price is going to go next. And then fundamental analysis is like the earnings of a company, you know, fundamentals, news, stuff like that, in order to know or predict where the price is going to go. Now, as traders, we mainly use technical analysis. Some traders do implement fundamentals. Heck, maybe some trade completely off of this, but for the most part, most traders do just use technical analysis. And this is what I will be teaching you guys, because this is pretty much all I use, and it's worked really well for me. So we'll be focusing a lot on technical analysis. Okay, so I'll see you guys in the next video. Okay, so what is MetaTrader 4 and what is MetaTrader 5? First of all, what is a broker? So a broker is something that you enter trades on. You buy and you sell, stuff like that. Now, MetaTrader 4 and 5 are third parties that you connect any broker to, or depending on the type of broker, you should be able to connect it to these. Okay, so the reason MetaTrader 4 and 5 exist is for convenience, because imagine you're using broker X and you want to switch to broker Z, let's just say, and you want to switch because you find out that broker Z has lower fees. So you want to switch from X to Z. But now you're going to have to learn how to use the new broker, where the buy button is, learn all the ins and outs. Wouldn't it be more convenient if you can just learn how to use a third party and connect any broker to that third party? Well, that's exactly what MetaTrader 4 and 5 is. Now, honestly, forget MetaTrader 4, it's the old version. MetaTrader 5 is a lot better, especially if you're going to be trading stocks. A lot of brokers that you can enter trades on have maybe thousands of stocks, but if you connect them to MetaTrader 4, you'll only see maybe 10, 20 of the thousands of stocks that are available to trade. So MetaTrader 5 is really important. Okay, in a different video, I'm going to be teaching you guys I'm going to do a tutorial on how to use MetaTrader 5 and actually enter a trade and do all of that. But now you guys know what MetaTrader 4 and 5 are. I'll see you guys in the next video. Okay guys, let's do a tutorial video on how to use MetaTrader 4 and 5, okay? So MetaTrader 5. I don't really use MetaTrader 4, so let's look at MetaTrader 5. So this is what it looks like. At the very right side, it's gonna say new account. New account. So I'm already logged in, that's why my name is at the top with the broker, live, all of that. But if we go new account, you want to log in. First, you got to search up the server name. So you're going to get the server name from your broker. Okay, so once you make an account with whatever broker you want, you will be able to get a server name. And then you type it in here, whatever it is. Okay. And once you do that, let's say it's go do whatever this, right? Then you can put in your login ID and password. These things you also get from your broker, okay? Once you log in, it's going to look like this. So you can see I'm using, it says Shiroz Afridi at the top, Blueberry Markets, that's the broker I use, and this is a live account, okay? And I'm at the settings at the bottom right. Now, at the very left, it's going to say quotes. So you can search up whatever you want. This is kind of like my watch list, I guess. Let's say you want to trade Puma. Oops, P-U-M-A. It's right there, right? It's going to look like this. Let's say you want to trade Home Depot. See, it's right there, HD, Home Depot. Or you can search up Home Depot like that. There you go. And if I click on it, it's going to show up as check mark, and now it's going to be here at the bottom. Okay, and you can remove it too by searching it up again and then just doing that. Okay, and now look, it's gone. Now if you click on it, if you click on whatever, let's say you wanna, and you click on details, it tells you the contract size, which is 100 over here, right? Contract size, I don't know if you guys can see it, it's 100 it says, and that's going to be important for the position size calculator, but don't worry about that right now. Don't worry about that right now at all. And then over here, chart, so you can click on something and chart, and it's going to take you here, and then look, chart, right? And you could use the charts here if you want. I don't recommend it, but that's what TradingView is for, not this, but you could do this. Okay, and then on trade, these are all the open positions. Blue means you're in profit, red means you're in loss, and at the top it tells you how much you're up in total, shows you your balance, all of that information. And on history, you can see your results, right? All your results in the past maybe week, right? Past month. Maybe you want to do past 3 months. Whatever it is, you can see your results here, okay? Now, I'm going to teach you guys how to enter a trade. So we're going to do a practice trade on, let's see, we'll do Ethereum. Trade. Okay. Now, remember when I taught you guys how to calculate leverage? And when it was telling you to put in the contract size, well, you want to go to details and look for the contract size. So for Ethereum, it's 1. Okay, I think for cryptocurrencies, it's 1 usually, but for stocks, it's always 100. Doesn't matter what stock you're looking at. If it's MetaTrader 5, it's always 100. Now, once you use the position size calculator and you figure out what type of lot that you want to buy with, let's say I want to buy Ethereum at 0.01. Okay, I did the calculations on the position size calculator. The answer was 0.01, so I just typed that in here. Maybe it was 1.59, whatever it was, you just type it in here. Okay, in this case, I'm just going to go with 0.01. And then you can press buy over here at the bottom right in blue if you want to enter a long position, or a sell by market at the left in the red, which is a sell short position, okay? And you can put in your stop loss here, your take profit price here, or you could do it after if you want. So in this case, we're not even gonna put in our stop loss or take profit price. Now, where it says market execution, you can click on it and change it to buy limit. So market execution means whatever the price is right now, you want to enter a sell short or a buy. But maybe you want to do a buy limit. That means at this price, which you're going to type here, you want to enter a buy order, meaning if the price goes there, then it automatically buys. Okay, and you can also do a sell limit, and it sells at this price, whatever price you pick. Sell short, I mean, right? Anyways, we're gonna do market execution for now, and we're gonna buy. When you buy, it's gonna show down here. Where is it? So I already had a couple other Ethereum trades open. You can see Ethereum here. Look at the one where it says Ethereum 0.01, and I'm losing 3 pennies. You can see I'm currently down 3 pennies. You can click on it and click modify, and you can always adjust your stop loss. Maybe you want your stop loss at 1,000 and you want your take profit at 5,123. Modify. And now if you click on it, look, I'm losing 4 pennies, but if you click on it, it's going to show you where your stop loss and take profit is. You can modify and change it if you want, whenever, right? And you can click on it and you can click close position. And then you just click here at the bottom, close 0.01 in the yellow, and boom. And it's going to show down here that I lost 3 pennies on history. Okay, it's that simple. That's how you enter a trade. So pretty self-explanatory, as you guys can all see. And yeah, I'll see you guys in the next video. Okay, so candlesticks. Now, guys, the chart is made out of candlesticks, so it's going to be really important that we know exactly what these are and exactly what these mean. Okay, now you could click here and change it to a line chart, and you could use any other type of chart you want. And with the line chart, it's nice and simple, easy to read. But the thing is, you're gonna have to use candlestick and no other type of chart if you want to be a profitable trader. And the reason for that is because, first of all, every profitable trader uses candlesticks. And the reason is because, you know, our job at the end of the day is to know if the price is going to go up or down. If it's going to go up, I'll buy. If it's going to go down, I'll sell. But for me to actually know which direction the price is going to go, I need as much information, data, and clues as possible. And these candles give me the most amount of information. So we only use these, okay? So first things first, the green candles mean that the price went up. The red candles mean the price went down, okay? Now, every single candlestick has a lifeline. Okay, so what that means is every single candle eventually closes. So for example, this is the candle I'm on right now. And when this candle closes, the next one will begin, and then the next. And this will go on forever, okay? But how long does it take for a candlestick to close? That depends on what time frame you're on. So you can see I'm on the 1 hour time frame right now. I can switch to 10 minutes, 1 day, it doesn't matter. I'll use 1 hour as an example. Since I'm on the 1 hour time frame, every single candle is gonna close after 1 hour. Therefore, every candle is gonna represent 1 hour. And over here, you can see it says 49 minutes and 28 seconds, and there's a countdown. That's how much time is left until this candle closes. Now, if I go to the day time frame, the 1 day, now every candle is gonna represent 1 day. Okay? Now, I'm gonna draw a candle and explain the remaining details to you guys, but we're almost done here. So every candle is gonna tell me 4 things, okay? So the 4 things that every single candle is gonna tell me is gonna be the low price, the high price, the open price, and the close price, okay? Low, high, open, and close. So you're gonna see there's a pin at the bottom and top of these candles. Those are gonna tell you that during the 1 day period or 1 hour period, whatever time frame you're on, that this is the lowest and this is the highest. Lowest and highest the price went. And then you have the body of the candle, so the square, that tells you where the price opened, so started, and where it closed. So where the price was when the time was up, right? So open and close. If it's green, it opened lower and closed higher. If it's red, it opened up here and closed lower. So I'll give you guys a few examples too, just to make sure you're 100% good with this lesson. You can see the price opened here on this red candle, and it went a little bit up because there's a tiny pin here, right? And then it dropped, the price dropped all the way down here, right here. And then it went up here and closed here. The next candle began right next to it. The price initially dropped, then went up here, then dropped a bit next. And this will go on forever, okay? But it's really important to understand that if you want to be a profitable trader, you're gonna have to use candlesticks and no other type of chart, because these give us the most information by far. I'll give you an example. You can see that this is the highest the price went here, and we can clearly see that. But if you were using a line chart, it doesn't tell you the price went there. You guys see the difference? And if we want to be profitable, we're gonna need that information. It's crucial. Okay, so that's how candlesticks work. That covers everything. I will see you guys in the next video. Okay guys, so support is a level where the price has previously went up from. So I'll give you an example. Okay, this is where we are right now. but in the past the price went up from right here, so that's going to be support. As you can see, the price was falling and it randomly reversed from right here. So that's going to be support, and we're going to mark it by going to our second tool up here, arrow, and then horizontal ray, and we're going to click right here. Now, this here is also a level of support, okay? This here is also a level of support. We're just going to use this one here at the bottom as an example, okay? And this is a key level. This is also a decent level, but this is a key level because it's so much more noticeable, okay? The more noticeable, the better. Now, really quick, the price went up from here because people bought. That's when whenever people buy, the price goes up. Whenever people sell, the price goes down. That's what moves the market, buyers and sellers. So by drawing the support level, I've basically identified where the buyers are. So if the price was to go back down here and hit this level again, I can use the history, so what happened here, to predict the future, right? So I could assume that the price would go up from here. Therefore, I would buy. Okay? Now, once I enter my trade, I can have my stop loss slightly below support and my take profit a lot higher, so that now if I lose money, I only lose a little bit. But if the price goes up, look at how much I make. So I'm risking a little to make a lot, and I'm entering at a very strategic spot. Okay? So that's support. And resistance is going to be the same thing, but the exact opposite. So it's going to be a level where the price has went down from, like here. Okay, this is an example. This is also an example here. Even this is an example. But I like this one a lot because you can see the price went down from this area 1 time, 2 times. So there's a lot of sellers here. So if the price was to go back up there again, I could enter a short position this time and try to make money on the way down. So the same thing, but the exact opposite, right? And let's see how this plays out. Let's see what happens. And there you go. The price went down from here a 3rd time now. So that's the power of support and resistance. I will see you guys in the next video. Okay guys, so gaps are basically these right over here. So you guys can see there's gaps in the price. Now, you're going to see gaps mostly on stocks. Okay, on stocks there are a lot of gaps. And then on commodities, there's a very few. On anything else, there's close to 0. Now, I'll explain how a gap even occurs, okay, and what it means. So a gap basically means that, so the stock market opens at 9:30 a.m. Eastern time zone, and it closes at 4 p.m., okay? So let's say the market closed here, but then the next day in the morning, it opened up here. You see how there's a gap? From right over here to right here, right? So these gaps are very common on stocks because the stock market closes and opens every day. But things like gold and forex, futures, they only close on the weekend, so they're going to have less gaps. But ultimately, gaps act as a level of support or resistance. So if it's a gap below, if the gap is below the price, it's support. If it's above, it's resistance. But once it's filled, it's no longer acting as support. So I'll give you an example. You can see we have a gap over here. So the gap, a lot of people think it might be here, but it's actually over here because this is where the price closed before this gap occurred, right here, right? So that's going to be the gap, and this here is called the gap window. You could enter here or here, depending on how much you care about the entry for the particular trade. But anyways, that's the gap, right? Let's say it gets filled. This could be a good level to buy. It's support, okay? And then the second time, the gap doesn't really matter, but you may want to enter based off this level. But the point is, gaps are going to act as a level of support and resistance. They're more powerful on commodities or anything but stocks, they're more powerful because they happen less. When things happen less, they're more meaningful, I guess. So on stocks, you're going to see gaps everywhere. You don't want to pay attention to every gap, but gaps like this, big gaps that you can visually notice versus these small ones, they're going to be the ones to pay attention to rather than like the daily gaps like this one. You want to be paying attention to the bigger ones, right? This is a big one too. The price closed here and the next day it opened here. So massive gap. So what's going to be resistance? Right here. This would have been resistance. We did go above it, but it doesn't matter. It was still resistance. Okay. So you can use these levels to enter trades just like support and resistance. Okay. Same exact thing. Okay guys, so double tops and multiple tops / bottoms. So double bottom, double top, multiple tops, multiple bottom, same thing, right? But basically, let's say the price was going up and it started going down from here, trending downwards, and then it hits the same spot one more time. That's going to be a double top. There's going to be resistances here, 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 all along the way, but this is going to be the double top resistance. And if the price goes back down, this can become, check this out, now this can be a double bottom right over here, right? Now this is a double bottom. Now if the price goes back up here, check this out, this is a triple top. So these levels of resistances are very powerful. Now one thing you want to make sure is that when you're on the candlestick chart, you want to make sure that there are at least 30 candles. Okay, so if the double top doesn't happens with less than 30 candles, it doesn't count. I'll give you an example. This is a level here of resistance. How many candles do we have? Right, since we hit this again. So 1, 2, 3, 4, 5, 6, and maybe it hits it today or tomorrow. That's 6 or 7 candles. You need at least 30. Okay, so you need a lot of candles in order for it to be considered a double top or a double bottom. Like for example, if this thing was to fall down, right? Here we can use, if this thing was to fall down all the way here at double bottom, as long as it was 30 candles or more, even 25 can work, it's going to count as a double bottom. Okay, so these are going to be very powerful levels of resistances, and you can use them to enter trades. Okay, anyways, I'll see you guys in the next video. Okay, so trends and channels. So I'll give you guys an example, right? Let's say the price is going in an uptrend like this. So this is going to be an uptrend, right? So a lot of people, what they do is if you're in an uptrend, they're only going to buy at support or look for buys with their strategy. But then in a downtrend, they're going to look for sells because sure, the market goes up and down, but it's trending downwards, right? So this is a buyer's market. This is a seller's market. In a buyer's market, most people prefer to look for buys. Seller's market, most people prefer to look for sells. And then there's a sideways market where the buyers and sellers are equal, right? They're equally matched. No one is winning. And in this market, it doesn't really matter what type of trade you look for, as long as you see a good trade to the up or downside. Now, it doesn't mean you can't enter, like let's say you're in an uptrend. You can still enter shorts. It's just a little riskier, right? So that's what trends and channels are and how you can use them. Okay guys, so breakouts, let's talk about these. So let's say you have a sideways trend, okay? You have simple support and resistance. Now what I'm about to teach you applies to anything. A sideways trend, it applies to upwards trend, it applies to downward trends, it applies to double tops, double bottoms, multiple tops, multiple bottoms. It really doesn't matter what it is, it's going to count when it comes to a breakout. So let's say you have this trend here, right? And we can see that this green level at the top here, I'll change it to blue, is resistance, and the green level at the bottom is support. But what happens if the price breaks above resistance? Well, what that means is the moment price has broken above resistance, resistance becomes support. Okay, so typically one of two things will happen. Either this will go up. So when the price breaks above a level, it means it wants to go higher. So it'll either go up, or it'll either go back down here and then go up. And this will be treated as support. Some people buy here. Some people wait for a better entry to buy. It's really up to you how you want to go about it. But yeah, it might be smart to actually wait for a better entry. Anyways, that's how that works. Don't get me wrong, sometimes the price goes right back down. But breakouts increase the probability of upside, whether it's straight up or down and then up, okay? And the same thing if the price breaks below support, same thing, right? Or just straight down. Now, how do you know it's a real breakout versus a fake breakout? So that's where candles come in handy. And you guys did learn about candles earlier in the lessons. So what you want to see is, let me just draw a candle for you guys really quick. So we're gonna have a green candle here. You want the candle not to look like this, because this means that the price went above resistance. You want to see the candle close above resistance like that. That's a breakout, okay? So make sure, make sure you're looking for the close. So that's what breakouts are. Now, I'll give you guys another example. Let's say the price is going down, right? This is a level of resistance here. This is a level of resistance. These two are resistances, okay? And this was support. This was support. So you see how the price broke below this level of support? This level here, right there. That level is going to act as resistance if the price goes up, okay? Here, I'll give you a simpler example. You can see this level here is resistance. If the price was to go back up and break above it, it's now support. So any support that's breaking becomes resistance. Any resistance that becomes broken becomes support. It's just a universal law for breakouts. Okay, so volume, you're typically going to see the volume indicator here. But if you don't see it, you're going to have to click on indicators and search up volume. And then right there, volume, okay? And it tells you the current volume. So if you drag your mouse over here on the current candle, it tells you your volume is 4.86K. I'm talking about these numbers here. You can see the change as I move my mouse, right? And here you can see it at the bottom too. You can always delete this if you want, or turn the visible, show it or unshow it, right? But people use volume to predict price movements. So you guys can see, so volume is basically is activity. So if there's a lot of volume, that means there's a lot of buyers and sellers. A lot of red volume would mean a lot of sellers. A lot of green volume would mean a lot of buyers, right? And let's just say you see that the volume is getting lower. That could mean that, price is, or let's say the volume is getting higher. That could tell you that there's a big move that's going to come, right? You see volume is increasing. It's slowly getting bigger, bigger, and bigger, like over here, right? You had this green candle, and then a higher green, and then a higher green, and then it still continued higher. So there's a lot of ways you can use volume. I personally don't use it that much, but depending on your strategy, depending on how you want to go about it, you could use this, okay? So I did want to teach you guys or explain to you what it is. At the end of the day, some traders use this, some traders don't, and everyone uses it a little differently, okay? Okay guys, let's go over patterns now. So there's a lot of patterns. There's honestly like thousands, but I'm only going to go over the most important ones. And the first most important pattern that I'm going to go over is the bull and the bear flag, okay? So when the price goes up and it starts to rest, you can call it rest, consolidation, whatever you want. I call it consolidation, okay? It's the same as resting, but it starts to rest here. This is a bull flag when the price goes up and rests. When the price goes down and rests, this is a bear flag. So this is a bull flag, this is a bear flag. A bull flag is bullish, meaning the price should go higher. This is bearish, meaning the price should go lower. Okay? Now there's different types of flags, whether it's bull or bear. We'll use bull as an example. So when the price goes up, the way it rests, there's different types of them. So there's the sideways rest, right? It's just sideways. There is, and that one is neutral. So we'll actually have this here. There is the one that's downwards, and there is the one that is upwards. So you have up, you have side, and you have down, right? You can see the angle is down. Now, out of all three of these, you probably think this is the most bullish. But the truth is, this is the most bullish. This is number one. Okay, and this is number two, and this is number three. This is the least bullish. So I would rather buy based off this pattern than these two, okay? I know the trend is up, but these trends are meant to be broken. Think of it that way. So uptrends usually break to the downside. Even though they're trending higher, the breakout usually occurs to the downside. Downtrends, they're trending lower. If you're trading within the trend, it's fine if you're looking for sells, but if you're looking for breakouts, it's better to look for a break above and continuation to the upside, okay? So that is the bull flag, okay? Next I have for you guys, let's see what pattern, ascending and descending triangle, okay? So we'll just search it up. Now, before we do, let me give you guys a few examples of the bull flag. Okay, let's see. Let's go to Bitcoin. Ignore this head and shoulders pattern. We'll talk about it later. But check this out. You had a big move up. You had lower highs, and you had lower lows here, right? Not perfectly drawn, but whatever. Lower highs, lower lows. You broke above and went higher, right? Same thing here. Let me delete this. You can see you had a big move up, and then you had lower highs, and you had lower lows right there. Bull flag, you broke above and you went higher. So, and it's happening again. Big move up, lower highs, lower lows. So this should break above and continue higher. But if you had shorted based off a bearish breakout, you would have gotten destroyed here, right? So, yeah. Anyways, now let's talk about the ascending and descending triangle. So this is the ascending triangle. When you have a flat high, meaning the sellers are not getting stronger, they're remaining the same, but the buyers are getting stronger and stronger and stronger, right? So this will usually break above and go higher, okay? And then you have the opposite, so a descending triangle. And this is the opposite. So the sellers are getting stronger and the buyers are getting, they're not getting stronger or weaker. So since the sellers are getting stronger, this will usually break below and go lower, okay? So these are the ascending and descending triangles. And one of my favorite patterns is the head and shoulders pattern. So let's talk about that. So before I give you an example here, let's just use this. So a head and shoulder, pretty much it's just the head and the shoulder, right? So when you have on the price something that looks like a left shoulder, a head, and then a right shoulder, this is a bearish head and shoulders pattern. So this will usually break below the neckline, the shoulder, and then go lower, okay? But if you had the opposite, wait, I messed up, sorry. So if you guys had the opposite, so like I can just use this as an example here, right? You can see you have a head over here, or shoulder, sorry, a head, and then a right shoulder. You broke above, and now you should continue a lot higher because of it, okay? So this is a bullish, and this is a bearish head and shoulders pattern, and these patterns that I'm telling you are the popular patterns. So there's a lot of patterns out there. So if you just search up trading patterns, right? Let's go to images. These are the ones you want to mainly focus on, okay? But anyways, the head and shoulders pattern is also really important, and there is one more really important pattern I'm gonna tell you guys about. So this is gonna be the last one I teach you. It's gonna be called a wedge pattern. So when the price is in a wedge, so like this. So the buyers and sellers are both getting stronger, the pressure is building up. Either the buyers will win or the sellers will win. If the buyers win, boom, this goes crazy to the upside. If the sellers win, this goes crazy to the downside. And now the deeper into the wedge pattern the price gets, the bigger the breakout. Okay? But if it doesn't go that deep, then it can just versus like, right? So keep that in mind too. And you can also have a bull flag that's kind of made up as a wedge pattern, and this is bullish. But then if it was like this would be bearish, right? That's bearish, and this is bullish. Okay, and I'll give you an example of a wedge pattern on Tesla right now, actually. So you can see there's a beautiful wedge pattern here, and this is starting to break above, which is why I had one of the reasons I wanted to enter a long position, and now hopefully it hits my take profit. And we also have Costco. This happened a couple of years back, I believe, right here. Check this out. We got to the end of this pattern, and look how high we went, and we're still going so much higher. So that's the power of these wedge patterns, okay? Okay, so now I basically taught you all the important ones. If you want to learn more, there's a few here. But the ones I told you guys about are the most important ones, okay? So focus mainly on these ones, and if you want to learn more patterns, then here you go, okay? Okay guys, I'm going to teach you the RSI indicator now. So we're going to click here on indicators, and then we're going to search up RSI. Mine is starred, so that's why even if I don't search it up, you'll see it right there. And this is the relative strength index, okay? So RSI, relative strength index, and it tells me the strength of the market. I can move it up, or I can have it down here. I can delete it. I can minimize it back to normal, or maximize it back to normal. I'm going to maximize it. And I'm going to click on the yellow line and remove it because I don't use it. Now, remember, this indicator works for all time frames, hourly, daily. It doesn't really matter, okay? So let me explain how this indicator works. So this indicator tells me the strength of the market. So if the market is oversold in terms of strength, or if it's overbought. So this is the RSI. It moves up and down. You're going to see there's a bottom line here, and it's the 30 level. And there's a top line, it's the 70 level. There's levels above it, there's levels below it, and there's the middle level to 50. So 30, 50, 70. Now, whenever the RSI is touching the 70 line or is above it, it tells me the market is overbought, so it's too high up, and I should be looking for sells. But whenever it's touching the bottom line or is below it, it tells me the RSI is oversold, and I should be looking for buys. And if you see a red color, that means it's extremely oversold, and it's really good time. It's a really good time to buy. And if you see it green up here, so right here, that means it's a really good time to sell. Like really, really. This is just a good time to sell. This is a really good time to sell when you start to see it green, okay? Now, a lot of people use this indicator by itself, but I like to use it with other factors, so other things I taught you. I'll give you an example. Maybe you can see that we have support over here. If the price hits it, that's one reason for me to buy. But if the RSI also hits the bottom line or is below it, now I have two reasons, and that is going to be two reasons to buy. I also taught you patterns. Maybe this is going to be a bull flag support, a bullish pattern, and the support of that bullish pattern with the RSI, right? Stuff like that. These are the things you guys want to look for. Okay, the next indicator I'm going to teach you guys is going to be the moving average indicator. So let's open up indicators here, and we're going to search up MA. Okay, there's multiple different types of moving averages. There's the ribbons where you have a bunch, but I'm going to do the SMA, the simple moving average. Okay, right there. And you can open up multiple. You can change their colors on settings here to differentiate them, because you can also click on settings and go to input. And do you want the moving average that calculates the past 9 candles, or do you want the 200 candles? So typically 200, 150, 100, and 50 are the ones that I use. So 50, 100, I use the 152 and the 200. So 50, 100, 150, 200. So again, you can have multiple. You just search it up again and open it multiple times. See, now I have 2. Okay, but anyways, I'm going to go back and delete that. But see, it's right there again. I'm going to delete it. I did that by pressing Control Z, Control Y to make it faster. But anyways, so you can use moving averages as, like, they can kind of help you figure out what trend we're in. So if we're on the 200 moving average, whenever we're above the 200, it's going to tell me we're in an uptrend, and maybe I only want to look for buys, right? Depending on your strategy. You could use it that way, or you can use it as support and resistance. So a lot of people like to use these as just levels of support and resistance, just like I taught you what support and resistance is, right? So you can use it that way. It's up to you. Now, the last pattern, or the last indicator that I want to teach you, or second last actually, is let me show you guys. No, sorry, this is the last. It's the Bollinger Bands indicator. Okay. So Bollinger Bands indicator. Let's open it up right now. Hold on. Not this, sorry. There we go. Okay, so let me delete these other ones. Oops. This is the one I was looking for, I think. Yeah, this is the one. Perfect. Anyways, so you can see that these are just a bunch of moving averages. There's the one in the middle, red. The one below it means the market is slightly oversold, and the one below that means the market is very oversold. And then obviously this would be overbought and extremely overbought. So what a lot of people do is they look for sells here, and then they exit their trade here. They look for buys here and exit their trade here. Some people buy here, sell here. Some people buy here, sell in the middle. Some people short here, sell at the middle. So there's many ways to use it, but these kind of help you figure out what the next move will be. You can see, if you had bought over here, the price pierced through it, but it didn't close above, and now it's continuing higher. If you had shorted here, you would have made money. If you had shorted here, you would have lost money. Here you would have lost. Here you would have probably won, depending on your risk to reward. You would have won. So the goal is to win more often than you lose, and this definitely helps you attain that, okay? So this is the Bollinger Bands indicator. I will see you guys in the next video. Okay guys, so this is probably going to be the most important video of the whole course. So it's about how to become profitable. So we all know the price can only go up or down, meaning even if you guess, you still have a 50% chance of being right. It's like flipping a coin and betting on heads or betting on shoulders, 50-50. So you got to think, why do majority of traders lose, right? So once you figure out why, only then can you know what to fix and then become profitable. Most people don't do that, and therefore they never become profitable. But I'm about to tell you the 3 main reasons that people are not unprofitable. Out of all 3 of these, we're going to talk about all. Now there is one and it's called psychology or emotions, whatever, right? Emotions or psychology. This here is not the real reason that you are unprofitable, even though that's what most people say. That's what most people think. But your emotions and psychology does have a role to play with this. So if you can't control your emotions and psychology, how are you going to control your risk management, which we'll get into? How are you going to care about any of this if you're way too emotional? So I guess this does, in a way, this is the biggest reason, but it's not the direct reasons. These are the direct reasons that most people are unprofitable. So let's talk about risk management and how emotions could be affected by risk management, or how risk management could be affected by emotions. So let's say you have a $100,000 account or $100 account, right? We all know that no one can have a 100% win rate. Everyone is bound to lose, even the banks, hedge funds, everyone, and you're also included in that. So am I. Everyone is. Every hedge fund manager is. So you got to prepare to lose trades. Doesn't matter how good the trade is. Doesn't matter how good the setup looks. You got to understand you can lose it. But if you risk too much, then you're gonna lose a big chunk of your money. Like if you're risking 30% of your capital per trade, you only need like three or four losing trades in a row to lose everything, and that is inevitable, right? So by risking just a little bit of your capital per trade, like 2-3%, 5%, at most 10%, you're gonna be able to survive the losing streaks and not have your account blown, and actually basically live to see another day, if that makes sense, right? So you don't ever want to risk too much. You always want to, because again, you want to survive the losing streaks. And again, if you're emotional, if you're emotional, like the greed emotion, then you're gonna risk too much. Or maybe you're risking the right amount, but you lose two in a row and you want to make it back with one trade. That's also, greedy. That's also, you're angry about your previous losses, so you risk too much, and it ties in with this. So you see how emotions has a big role to play with the most important out of the three, and this is the most important out of the three. The second thing is natural mathematics. So this here is the first most important. This here is the third most important, and this here is the second most important. Here, let me draw that better. So 1, 2, 3, okay? So the third most important is natural mathematics, but it's still important, as it is one of the fundamental rules that people lose their money. The second thing is, again, natural mathematics. So I'll give you an example what that means. Let's say you have a $100 account, and you risk 1% per trade, or 5% per trade, 10%. Doesn't matter what the number is. It could literally be 1% per trade. Let's say you have a 50% win rate. Let's say you have a 50% win rate. No matter what happens, you're going to lose all of your money over time. But why? You have a 50% win rate. It's because natural mathematics. So if you have $100 and you make 1%, you have $101. Now, if you risk 1% of $101, you will lose so no matter what happens, you're going to overall always go to zero. So you guys can look into it more, ask ChatGPT, do whatever, but I'll give you another example. Let's say you have $100 and you lose the first trade. So now you're at $99 because you risked 1%. Now if you win the next trade and you risked 1% again, and you won the trade, well, 1% of $99 is 99 cents. So you're now at $99.99 balance, even though you lost your first trade and you won your second. Shouldn't you be at break even? Now, even if you won your first trade, the point is over time you will always lose your money over time. So let me give you the solution to this. You know what the solution is to risk management? Just don't risk too much and control your emotions. So natural mathematics, the solution to that is you risk a dollar amount. So if you have $100, you want to risk 1%. Okay, risk 1%. Risk a dollar on the trade. If you lose, On your second trade, keep risking $1. That original 1%, the 1% of the original balance. Okay, you lose 10 trades in a row, you're at $90 now. Guess what? You keep risking 1% of your original $100, not your new $90 balance. And then if you win the next 10 trades, you're at a 50% win rate and you're back at break even instead of under break even. And the third thing is spread and fees. And this will also make things so much more worse. Now imagine worrying about natural mathematics, not solving that issue, but on top of that having the spread and fees as well. This stuff compounds together in ways that you don't even understand. Especially when you combine it with risk management. It doesn't matter what you do. If your risk management sucks, you will lose all your money. Okay? And again, losing all your money from bad risk management, you get more emotional meaning lose more money, and then it's just a non-ending cycle. So the best thing to do is just control your risk management right off the bat. A lot of people think, okay, let me, just go crazy, make $1 million first, and then I'll play it safe. It doesn't work like that. You'll never get to your $1 million if you don't have good risk management. Or, I have $100 in my account, let me turn into $5,000 first, and then I'll play it safe. You keep telling yourself that, but trust me, when you reach your 5K balance, you're going to be like, okay, let me get to 100K first. Okay, let me get to $1 million first. These habits stick around with you. They will never leave you. So it's better to get into the habit of controlling your habits right off the get-go. And at the beginning, you're like a sponge. You're absorbing, you're building habits. And if you're building bad emotional and risk management habits, then it's only going to get worse and worse. Okay, you just keep digging yourself deeper in that hole. So don't do that. Okay, I've told people not to do that, and they don't listen. And it just never works out, guys. So trust me on this one. Okay, whenever you're about to do something that doesn't follow good risk management, you're risking too much, you're breaking your rules of risking maybe 2 or 1% per trade, just remember what I told you. Okay. Anyways, the spread and fees are also important, right? At the end of the day, the price can only go up or down. You have a 50% chance of winning, yet a lot of traders are losing money, and one of the reasons is the spread and fees. Even though this is not the biggest reason, it's still one of the three direct fundamental reasons that people lose money. So it's something that you should look into. Look for a broker with the lowest spread and fees, but make sure it's regulated and it has other things like leverage, enough things that you trade, all that, the trading instruments. But spread and fees is also really important. Okay. So the platform I use with low spread and fees at the current time, the link of that will be in the bio. So if I find a better one in the future, I'll change the link and I'll change the one that I have in the description of this video. Okay. But yeah, guys, this is it. You know how to enter trades, you know how to calculate your position size, you know how to predict where the price will go with patterns, indicators, support and resistances, trends, channels. There should be no reason for you not to be profitable. And if you're not profitable, you need to go back and analyze these 3 factors that I just taught you right now, because these are the only reasons that you're not profitable. It's nothing else. Okay. So with that being said, I'll see you guys in the next video. Okay, so guys, it's about to get real now. Okay, I'm going to teach you the strategy. I already taught you the strategy technically. Now I just got to teach you how to use it. So remember, the price can only go up or down. When you use the things I taught you, your probability of winning will go up by a lot. Now, what we want to do is we want to look for multiple reasons to buy, especially depending on the stock. So this is Tesla. We really don't need that many reasons to buy. We just need a few institutional factors and you should be good. Okay, but even then, the more the better. But for something like a stock no one's ever heard of, like, I don't know, a small cap, like a penny stock, something more volatile, you need multiple reasons, because institutions won't really buy those stocks like they're going to buy this stock. This one is safer. So this doesn't need a lot of reasons for you to buy it. Like, I'll give you an example. If you're 6 feet tall, you have if you're 5'8", let's say you're 5'8", you have to work really hard to dunk. But if you're 6'8", you don't have to work that hard to dunk. Same thing here. If you're a stock like Tesla, something that we know is going to stay around, like even BMO, TD Bank, Pepsi, Coca-Cola, we know these stocks are going to stay. Institutions are all looking at them. They have it easy. These levels will be more respected. But something like, I don't know, a penny stock, it's going to be, again, you need multiple reasons for institutions to give a shit. Okay? So what we want to do in general is look for multiple reasons to buy or sell. Okay? So for example, see how the price was falling here? Actually, let's go, yeah. See how the price is falling? Where do we look for a trade? Well, I remember this one setup, okay, right there. Let's go back. So we're going to start off with factor A. I see a trend. This is the pandemic low, the coronavirus crash. And then this was the next major crash right there, right here. These are two major pivots. We're not talking about some random trend on the 1 minute. No, we're talking about the pandemic low. And then this was the next crash that occurred on Tesla and the stock market, actually. So if we connect these, let's get the array. If we connect these, let's connect it as perfectly as we can. Okay, now that is a level. This is a good level to buy. Okay. Now, what else do we have here? I'm giving you this example. I entered a trade here a long time ago. Okay, but I'm still giving you this example because it's such a good example. Okay, but you'll get to see new examples real time every day in the daily classes. But I want to use this one because I'm trying to teach you guys this. And you'll understand why at the end this is such a powerful example at the end. You'll see what I mean. But you have this level, the trend, and you also have this major gap fill here. This gap didn't get filled since 2023, and now over here it's like 2024. So if it hits, there should be a lot of liquidity. Remember liquidity and how it works? So, and also this level hasn't been hit since 2022. So a lot of liquidity there too. Now, notice how these levels kind of are in the same area. Like even if it drops here, you're gonna have your stop loss below this, right? Because they're so close together. So that's gonna be very important. Keep that in mind. So we have two levels basically converging here, but even here still counts, here still counts. It's around the same area. The perfect scenario would be like, boom. That would be perfect. But even like here is okay, even like here is okay. Okay, but obviously this would be way better. Now, why is it better that we buy at a level like area like here versus like an area here? Well, here you have two reasons to buy. Here you have one. Two is always better than one. Okay, so the more reasons you have, the more institutional interest there will be. The more institutions are going to be likely to buy. So you have one level here, another two level here. What else do we have? If you get the Fibonacci, so the price is dropping. This is a low, then this is the high. If you connect the low from here to the high, that is a Fibonacci sequence, 786. So that's three reasons now why that's a really good level. Pretty crazy. Okay, now another reason is, I believe it was a channel or a level. Let's just do I think it was a level, yeah. So this pivot to this pivot, let's connect them. Look at that. All these levels converge around this area. So if the price drops into somewhere here, this would be a very good area to buy. Okay, there's 1, Here, I'll change the colors of these. So we have the red line, support. We have this line, gap fill support. We have the trend line. That's another level. So that's 3 so far, plus the Fibonacci converging with them all. 786. 4 reasons to buy. Now, let's see what happened. And this is an important gap fill, by the way. This isn't a regular gap fill where one day the market opened higher. No, the market went up from here because it was caused by good earnings. This was only, this revenue was down 1%, 1.5%, but this was up 5%, so it went up, right? That had to get priced in. So institutions buy and sell because the value of a company changes based off of their earnings, and so that has to get priced in. And it did very quickly, boom. And then the rest of the movements is just natural profit taking, whatever. Now, if price falls into that, you know that's a really good level. So let's see what happens. I know what happens, but there you go, boom. Now, obviously it reversed. I already knew it was going to reverse because I've seen it before. I'm giving you this example for a reason. Okay. Now, it reversed here, but here's the key detail that you guys don't want to miss out on is there was earnings here. Earnings. Right here. And there was negative 8%. So the price is here. You know, especially for big caps like Tesla, there's a reason why the price is down here or up here. Oh, if it's down low, I should buy. I'll make a lot of money. To a degree, yes, long term especially. But in general, there is a reason why something has dropped so much. There's a reason why this stock went from up here, 408, to down here, 141. Okay? Now, something bad just happened. We had negative 8% earnings, negative 4% revenue. That's very bad. But the price still went up. And that shows you the power of technical analysis. How often does something like this happen? Not very often. Red, red, down. Red, red, over here, down. Over here, it was green, green, but it still went down here. Why is that? Well, there was resistance right there. If you just simply connect this to that, right there, pivot, 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 it went down even though earnings was good. And it was very, very good. Look, plus 2% on revenue, whatever, but 14% on earnings. That's insane. Earnings and revenue were higher than expected, way higher, and it still went down. Here, they were way lower than expected, still went up. That shows you the power of technical analysis. Now, why did they sell here, even though earnings was good, and why did institutions buy here, even though earnings was bad? Well, have you guys ever heard this before? Maybe you haven't, maybe you're new, but they say the value of the stock is determined based off of what people think the stock will do in the future. So if I'm buying Tesla right now, it's not because of what it's doing right now, it's because of what I think it's going to do in the future based off of its current actions. Unless it's something like Pepsi. That's not a growth stock. Tesla is a growth stock. So people basically said, I don't give a shit if earnings is bad. I think it's bad for a reason right now, but it will get better. It's a growth company. When they're done innovating, they're going to make billions, so I don't care. I'm buying. It's a good level. And if it goes down a little bit because of bad earnings, I don't give a shit. I'll buy more. That's why. So this is another institutional knowledge that you guys know now, another little nugget. So you can use that because if you're trading and you see it's a growth company, you're able to not try to. You guys will understand later, okay? Right now, I don't want to get into this right now. I don't want to confuse you guys, but when we really get into it, it'll make sense, okay? But there's multiple ways you can use this. Some ways I'll have to remember when we actually find a scenario, because you gotta remember every chart is different, and you gotta apply logic. Once you learn all these things, you will learn how to apply these things slowly over time, okay? That's what the daily classes are for. They're so very important. Anyways, now you guys know about the converging factors because I just gave you a perfect example, okay? Now, I want to give you another example on, oh yeah, there's actually another factor here I forgot to mention, the pattern. What pattern is this? You guys tell me. When the price goes up, okay, so when the price goes up, lower highs, lower lows, what pattern is this? It's the bull flag. Same thing happened here. Bull flag. This is a bull pattern right here. So we were buying at the support of the bull. So the pattern plus the support of the pattern plus the gap fill plus the trend plus the Fibonacci, five reasons to enter a trade there. And that's how you use the patterns. I love using bull flags, especially their support, for buying. For selling, I like to opposite, right? But in terms of patterns, I really only use bull flags and bear flags as an indication of whether the price will go up or down. Okay, let's go to Bitcoin, and I want to show you an example there. Right here. Back over here, previous all-time highs, we hit it, formed a bull flag, right? Now, one thing that strength, this is another important thing I want to teach you, just remembered, maybe I would have never remembered this in the daily classes. It's inevitable I remember to teach you everything, but right now what I'm about to teach you, I might have never remembered it, but I just did right now. Tesla, right? When it comes to Tesla, you see how there's a bull flag pattern here, and we bought at the support of it basically? Something that strengthens the support of this bull flag pattern is if it's parallel. I don't think this is parallel though, but let's just see. So let's connect these. Oh man, I gotta finish up my connection. My batteries are almost dead for my mouse. But basically, you have the support here, right? Pivot here, and pivot here. You drag it up. Is there really a parallel? Kind of, not really perfect. But if this was perfect, right? If the support levels here are parallel to this one, to this move here, and this move here, then the power of this support level at the bottom is going to increase. There will be a higher probability that the level will be respected. Okay? So again, this support level here will be a lot more powerful if it's parallel to resistance. Okay? Because that basically tells institution that the movements aren't a coincidence. They're happening because of a technical factor. And when movements are happening because of a technical factor, they're more likely to enter at those areas because the technicals will actually affect the movement rather than they're just there and they don't really have an effect on it. So parallels are very, very powerful. I want to give you another example on the Qs. I remember this. And this stuff works so well in the big time frames. Like, watch this. You connect this pandemic low into this low here. That's it. Just connect them perfectly. And then you drag this to the very, here, let's just extend this more a little. Boom. That's all I did. The pandemic low, the next crash. You take the bottom and you drag it to the highest point. So at the time was, we'll just go back here. At the time, it's this up here. Boom. Now, do you not think institutions would at least take profits here? Are institutions just going to sell everything up there? If the price goes up there, are institutions going to sell everything here? Probably not. But are they going to take profits? Some institutions have so much money, the BlackRock, billionaires, all those guys, they can't even sell everything if they wanted to. But are they going to sell as much as they can or at least take some profits? Absolutely. Should that cause a pullback for a trade? Absolutely. So let's see what happened. And by the way, this is not resistance. This is support at the bottom because it's been hit twice. 1, 2, it's officially support. This level has only been hit. This is just, we're predicting this level to become resistance. It's not resistance unless it's reversed twice. Now it's resistance, but until this until it reverses from here, it's not officially resistance. So let's see what happens. This might take a while. We'll wait. We'll wait. Price is going up. Institutions are buying. Now, will every single institution in the world take profits here? No, but there will be some, and look what happens. The price goes down from there. Okay, now it hits again. Now that level is weaker. Can it go down from there again? Yes, but now there's a less probability it goes down because there's less liquidity. The institutions that wanted to take profits at that level, most of them already did. Okay, so the price never had to go down. Now you see how the prices dipped a lot? See how the prices dipped a lot over here? This dip wasn't really supposed to happen, by the way. Now, let me explain this to you. This dip was caused by natural institutions taking profits because they wanted to sell based off the charts. That's why it happened. Do you guys know why the price went down from here? It's because of the tariffs. Remember back in, this was the tariffs. That's the only reason the price went down. This wasn't a move caused by technicals. This was a move caused by the tariffs needing to be priced in. That's why it dropped. But nothing happened here. This was just institutions like, oh, there's a level, good level, big time frame. Let's take some off the table. Let's buy something else. Maybe the EWZ, Brazilian markets, whatever it might be. Let's sell some here. Because they don't know the bottom. They don't know the top. They just know this could be near the top. And that's what we're trying to take advantage of. Okay, uptrends and downtrends. So I don't know if you guys have ever heard, but they say that the trend is your friend, right? That if the trend is going up, then you should be looking for buys. If the trend is going down, you should be looking for sells, right? And depending on your strategy, that could be true. It definitely does help to trade with the trend, right? So think about this. If the price is going up, down, up, down, up, down, up, and down, right? Sure, you could make money on the way down and on the way up, but since the overall trend is going upwards, right, probability is going to favor you if you look for buys, right? That's the first thing. And then of course, if it's a downtrend, yeah, you can still buy here and make money on the way up, but the trend is downward, so it's going to favor you to look for shorts, right? Now, another benefit of this is trailing, right? So for example, if you're trailing, maybe you maybe you bought over here, right? You bought over here and you made a quick little profit and you sold up here somewhere, right? You sold and you made a profit. But maybe you held about 20% of your trade so that you can just continue to hold it since the trend is up. So imagine you put in $100 here and this $100 turn into $200 right here, okay? And you sold, of that $200, you sold out maybe $160. So you secured $160 right here, right? You made a profit and now you're holding just $40 because the trend is up and you never know how much higher it could go, right? So that's another way of using the trends. So let's take a look at the charts and see what we can find, right? So let's go to the hourly or the daily, and you guys can see here the trend is up, right? So you had the big move up, pullback, consolidation, same thing here, big move up, pullback, consolidation, big move up, pullback, consolidation, and then the pullback, right? So you guys can see the trend is very clearly up. So, and you can see we're at support right over here, this blue line. So now I can buy at support and trade with the trend in this example, right? You can still look for sells whenever it goes up, of course, but again, probability of winning the trade is going to be a lot higher if you trade with the trend because the trend is your friend, okay? Okay guys, so this might be a long video. I want to explain to you guys what liquidity is, okay? And if you know what liquidity is, this video is even more important for you than anyone else, okay? A lot of you guys have learned about liquidity, or you think you've mastered liquidity, but I really don't think you have, because the way people teach liquidity is complete garbage. It's complete nonsense, and they miss a lot of key details. And I know this because I've learned, or I've seen what other people have to say about liquidity. Like, I'm talking regular traders you meet online, versus I've seen what institutional traders have to say about liquidity. And it's so different the way they use it. It's actually mind-boggling how different it is. So I don't care if you think you know liquidity, you need to watch this video. I'm about to give you the sauce. I'm literally about to give you guys the sauce. You're gonna thank me after this video, but you have to understand it. Okay, so lock in for this one. Okay, so first of all, people try to chase liquidity. So first of all, what is liquidity? Liquidity is literally just buyers and sellers. Okay, it's just buyers and sellers. Like, is a house liquid? No. It's because it's hard to sell it, right? You have to find a buyer. Is it as liquid as stocks? Of course not. Gold, stocks, certain things are a lot more liquid. I could have a piece of art that's worth $20 million versus a stock or gold that's worth $20 million, right? Gold is going to be more liquid. I can easily find a buyer if I want to sell it. That's what liquidity is. And that's why it's important. Now, who does this matter for? It matters for everyone in their own way. Now, here's the thing. How do I explain this? Okay, so liquidity is just buyers and sellers. That's what you got to know, okay? That's why some people prefer stocks over real estate, because they can just buy and sell a stock whenever they want and they don't have any issues. Now, there's a few things I need to teach you about liquidity for you to understand how it's going to apply to you, so just bear with me here. Now, when it comes to the stock market, crypto market, all of this stuff, liquidity doesn't matter for me and you. Unless you're trading with millions of dollars, it doesn't matter for me and you. We will always be able to find buyers and sellers. So let's talk normal money / normal people. So this will be under 10 million approximately, okay? This is not like 10 million on the dot. Even 10 million is nothing in the bigger scheme of things, but I'm just trying to help you guys understand. We don't have enough money to the point where we can't find enough buyers or sellers. There will always be enough buyers or sellers. Like, if I want to go to the gas station and I want to buy candy for myself, I can go to the gas station and buy candy for myself. But if I want to go to the gas station and buy and resell candy, but I have millions of customers, the gas station won't have enough for me to buy and sell to all my customers if I have millions of customers. No, I need to go to a factory. A factory will have more liquidity, okay? So for us, it doesn't matter. Liquidity in this sense doesn't matter, okay? But it does matter to billionaires, and that's going to be important for us to know later on. Okay, so for us, it doesn't matter. Doesn't matter really what we trade. We can put as much money in and out as we want, okay? Then let's talk about billionaires, the big dogs. These guys have so much money that depending on what they're trading, they're not able to put in what they want or sell what they want because there's not enough buyers or sellers. They can't find enough buyers or sellers. We will never have this issue, never. But billionaires, yes, they have this issue all the time. Okay, so if they want to buy a company, right, they're going to have an issue with how much money they are able to put in a day, right? And also how much money they want to take out. Sorry about my messy notes. So they're going to have big issues getting in and getting out. Now, what do these billionaires do, and why does this matter for us? Well, this is where the big caps and small caps come in. So there's different sizes of a company. Here, let me just... Okay, I'm just going to delete this. It's too messy. You guys can take a screenshot of this, but these notes are pretty bad. Just try to understand what I'm telling you rather than notes. You can write notes and you can just watch this video over and over. So again, I'm a retail trader with $1 million or less, or 10 million or less. Won't really matter. I will never have this issue of liquidity. If I'm a billionaire, I will have an issue getting in and getting out because there's not enough buyers or sellers. So what's the solution for billionaires? The solution for billionaires is to trade assets that are big in market cap. Now, what is a market cap? Well, let's search this up right now. Okay, the market cap is, there you go, the current price of the share, meaning in this case here, Tesla is worth what right now? $331 here. So the price times by how many shares are there. Like how many shares of Tesla exist in total. Whatever the number is, that is going to be the market cap. Okay? This is like the real value of a company. Like maybe the Gatorade company is worth $10 million and the, I don't know, freaking Vaseline company is worth $10 billion. This is going to be, so 10 billion is more than 10 million. And that's what really matters, by the way. The price of the company doesn't matter. The price can be increased or decreased based off the supply. So really, when it comes to whether something is cheap or expensive, it's about the market cap, not the price. I mean, look at Shiba Inu, look at Dogecoin. They're worth pennies, and people think they're going to 100x very easily because they don't know that it's about the market cap. The reason they're worth pennies is because there's so many of them versus Bitcoin, very little. But when you look at the market cap, Shiba Inu and Dogecoin have a pretty decently high market cap. It's going to be very difficult for them to even double. Okay? Anyways, so the market cap is what matters. Now, when it comes to big market caps, they have deep liquidity. So let's write this down. Deep, so big caps. Okay, bigger the cap, bigger the market cap, more the liquidity. Smaller the market cap, less the liquidity. Okay? And that's why the richer you are as a hedge fund or an individual, the more you're going to look for bigger caps. But when you're not that rich or you don't have that much money, you don't care where you find an opportunity, you will take advantage. Because if I have $100 billion, $100 billion, and I want to put in even 1% of my money into this really good investment or trade, I can't put it in if it's a small cap. There's not enough buyers or sellers. But a big cap, I can put in maybe even $10 billion and it won't make a difference. It won't even move the price maybe because it's just such a big cap like Nvidia or something really big. Now, that's how it works. So this information is important. It's very important information. You might not understand why yet, but you will. So I hope you guys understand now. The bigger the market cap, the easier it is for billionaires to put their money in and out of a company. For us, it doesn't matter, but for them, it matters a lot. Now, why do we need to know this? Why do we care about this issue or this issue these billionaires have? Well, it matters because when we're entering a trade, and maybe it's at a good discount. Maybe Gatorade, which is worth 10 million. Again, Gatorade is 10 million, okay? This here is $10 million market cap, the company. Vaseline, the company is 10 billion, okay? If they're undervalued and they're at a discount, what does that mean? They should go up. I'm just simplifying things right now. Let's say they're both at a good discount. They're both worth, maybe this is 10 billion again, this is 10 million, but let's say they're both worth $5 each. But they should be worth $10 based off of their fundamentals and charts and all the reasons. They're both worth 5 million or $5 per share, but they should be worth $10 per share. And the fact that they're not is a great opportunity. Cool. Out of these two, which one is the better opportunity, and which one has a higher probability of actually going up to where it's supposed to be, and which one is going to do it first? The answer is what has the bigger market cap, this. And the reason is because billionaires are going to be more likely to care about this. They're not even looking for small caps, but they're like, oh, even if we find a great opportunity, we can barely put any of our money into it, to the point where it won't even make a difference to us. They would have to find 1 million of these opportunities to be able to put in all their money into, divide it all equally, versus they just need one good opportunity in the big caps and they can put in all their money or whatever they want, right? Again, it depends on how many billions they have too, of course, but you get the point. Okay? I'm going to give you an example in the stock market, actually, when it comes to this stuff very soon, but that's why this will be a better trade and a better investment, because this will go up first. And then once this goes up, then institutions might be like, oh, let me buy a little bit of this too, if they even notice it. Or other people will, maybe, who have less billions or only millions, then they'll, you know what I mean? But this is institutional knowledge, which I just gave you. So the big caps go up first. Think about a crypto bull market, or any bull market ever. Think about the gold bull market. I'll give you that as an example right now. The gold bull market. What went up? Okay, when it comes to the crypto bull market, what happens? You see Bitcoin going up, then the big caps like Ethereum, Solana, XRP, then you see the medium caps go up, then the small caps go up, then you have the, the shit coins, then you have the meme coins, and then it's the end of the bull market. There's the reason why Bitcoin goes up first, because number one, liquidity. Institutions are like, okay, we're in a bull market, let's buy these, let's buy what we can actually buy. These shit coins don't have enough liquidity. Then they go up. Then they take some profits, and then they slowly start putting into Ethereum, other coins, and then they slowly start going down. There's two reasons they do this. Number one is because of liquidity, and number two is because why would they buy a small cap and try to make a bunch of money and take on more risk when they can just buy a bigger cap and make slightly less money but very less risk and still make a lot of money? They're going to pick what's safer, that makes a lot of money. Once that goes up a lot and these small caps haven't really went up much, then they're going to be like, okay, at this point, let's buy a little bit of this too. And then that's all you really need, because you don't need to put in a lot of money into the small caps for them to go up quickly. So this knowledge that I just gave you, this information, is very important, because with this information, you'll understand that it's going to help you time the market. Just because this is undervalued doesn't mean it's the right time to buy it. Maybe this is the beginning of the bull market for Bitcoin and crypto. I should be buying Bitcoin and the big caps. And the higher the price goes, now I can slowly start putting money into smaller caps, the large caps next, then the medium, then the small, then the meme coins, right? And on top of that, I can take profits from what went up and rebalance it into what isn't up. Does that make sense? So, and that's how institutions do it. That's how they make their money, rebalancing. Okay, this is something we're going to talk about more later, but anyways, now, this is what I explained about liquidity matters for trading, especially swing trading. But now we're going to get into the technical side of it. Now we're going to talk about liquidity. We're going to talk about it more later probably, but now we're going to talk about liquidity on how to use it with the charts. And how does it really work with the charts? Because I'll be honest, the way people taught it to you, it does not work out that well. The way they teach it. I've learned liquidity from the pros and everyone on YouTube. The pros teach it completely differently. I'm about to teach it to you like the pros. Okay? And this will save. This is gonna be the sauce. Rewatch this video a million times if you need to. I'm gonna be eating hulls as I teach you this. My throat kind of hurts. So first of all, before we get into the technical side of things, actually, let me finish with the thing I was gonna say. See gold over here, right? Back over, let's go to the weekly. See how gold was going up here? And it started consolidating, which is a bull flag. I was like, okay, gold's probably gonna go up. I wasn't expecting it to go this high that quickly, but I was like, it's gonna go up. So are the gold miners. They've already been going up. And since this is all the way up here, I was like, okay, now a stock like AHL will start to catch attraction. This is a quality company. It's a small cap. The only reason this hasn't went up yet, we were like over here at the time, like over here somewhere. I was like, the only reason this hasn't went up yet is because why would institutions buy this when gold was at such a good discount? But now I see them putting money into this because gold is up here and this really good gold mining stock is still down here. Now it makes sense. If gold was here, they wouldn't give a crap about HL, even though it's a good stock and it's in the gold sector. They care about gold because it's down here. But now that gold is up here, now there's going to be some institutions that care about this, and that is going to push the price up quickly. So that's how I was able to time this perfectly. We bought right here at this red line, $7.92. It's timestamped. This was an investment. We were supposed to hold it for a year, but it went up too quickly. We had to sell it in a few months, unfortunately. We didn't get the tax benefits if you're American, unfortunately. You get tax benefits if you hold it for a year. And I believe we sold like right up there somewhere for reasons which we'll get into later. Well, I'm teaching you liquidity right now. Anyways, that's just one example, right? Now, next thing I want to teach you is the technical aspect. So we're going to look at the Tesla chart for this one. I have a really good example. But so the first thing when it comes to technicals and liquidity is going to be, well, how do you identify liquidity first of all? We know there's buyers and sellers everywhere on the chart, but there are certain areas on the chart which have more liquidity. Okay? For example, let's go back in time. You can see this is support. Support is liquidity basically, and resistance is liquidity. Support is buying liquidity, resistance is selling liquidity. So the buyers are here, the sellers are up here. The buyers are at support, the sellers are at resistance, and the buyers and sellers are liquidity. Now, there should be, we can never know for a fact, we can only predict where liquidity is. No one knows where liquidity is, except for maybe the brokers that set up the limit orders, and they're not allowed to share that information with you, but we don't really know ever where liquidity is. We can only guess, but we got to make educated guesses. Over here on the weekly time frame, the price went up because people bought over here. Okay, if price goes back down, I'm sure there will be more buyers here than in a regular place because this is major support. A lot of people are going to be like, okay, that's a major level. We haven't hit it in a long time. There's going to be a lot of buyers. So there's a higher probability of the price hitting it and actually going up versus from a regular place. Okay, that's liquidity. That's how you use liquidity to enter a trade. Just support and resistance simplified. But you got to understand that when there's a lot of retail buyers, this is very important. You guys have to really watch this video a million times if you need to. If there's a lot of retail buyers, then there's even a higher chance that this actually goes down first before going up. Because if institutions are buying here, great. If retail, then not great. Okay? Does that make sense? Because they want to kick the retails out, make it go down, hit their stop loss, and then go up. Because if retail traders want to buy here too, just like institutions, but what they want to do is they want to scare the retail traders out or hit their stop loss, then let the price go up. Now, how do you avoid this? Number one, you avoid it by not trading on the smaller time frames. Though you can if you want, but they're harder. Because institutions don't need a lot of money to push the price on the smaller time frames. And they're not taking any risk. It's easy for them to move the price in the smaller time frames. So there's more manipulation, meaning bigger time frames are easier to trade on. And this is very important to understand. Okay, number two, bigger time frames are better because there are more institutions buying. Do institutions trade? No, because there's not enough liquidity on the small time frames for small moves. They don't care about that. Even if they find a really good trade, a small move, they'll be able to put none of their money into it for a small move. None of it. But for a big move, that's why institutions invest and swing trade on the bigger time frames. And when you're buying in areas where they're buying, you have a way higher probability of winning the trade, number one. And number two, you have a less probability of getting manipulated, because institutions have a hard time manipulating the bigger time frames because they got to put in so much money, and if it doesn't work out, which sometimes it doesn't work out for them because maybe other institutions are buying and then they get screwed. Does that make sense? Because they were selling here to liquidate a few retail traders, maybe they were shorting or selling over here to push it down and to screw some people over, but other institutions didn't give a shit. They're like, I don't give a fuck, I'm buying this. This is a great discount. Now the price goes up and those guys who tried to manipulate got screwed. So that's why bigger time frames have less manipulation. One of the reasons people fail at trading is because they're not trading on the bigger time frames, and here's why. Okay? So you can trade on the smaller time frames, but there's other factors you got to learn, which I will teach you later. Don't worry about it right now. Start off with the big time frames. Now, if the price hits, there's going to be a great probability of institutions buying here. Okay? Now, let's say the price goes up and it goes down. Well, do we have any buying liquidity left? We got buyers here, great. We got buyers here. This was a great spot to buy because we haven't hit this level in a long time, meaning more institutions are actually going to buy now. Okay? But if institutions just bought here and the price went up and it goes back down, do you think they're going to buy here again? Maybe new institutions that didn't buy here, but how many didn't buy here that are actually going to buy now? Probably not too many. The way institutions invest is they don't try to buy or predict the bottom. They don't know the bottom. They're smart enough to understand that they will never know the bottom. They can only try to buy near the bottom. So they dollar cost buy, meaning they don't know if this red line is going to be the low or if this orange line, yellow line is going to be the low, or if this line in the purple is going to be the low, or if this line here in the blue is going to be the low. They don't know that. What they do is they find good levels. They put in maybe they want to put in, I don't know, $10 million into Tesla. Maybe they'll put in like 2 million here, another 2 million here, another 2 million here, another 2 million here. And their average buying price will be somewhere in the middle. Like if you bought an apple for $10 and you bought another for $20, what is your average price for that apple? 15. That's what they do basically. They buy these at multiple different levels that are good. They end up having good low price. So when the bull market comes, when the prices go up, they're able to make a lot of money. And they do the same thing when they're selling. Sell a little here, sell a little here, here. Because they don't know the top, they don't know the bottom. They're not trying to, they don't care to. It doesn't matter. That only matters to the retail greedy trader who wants to get rich quick, who does not know what he's doing. That's not how retail traders think or do any of their action. Okay? Now, why this matters for us is that even if you find a really good level with other factors to why institutions should buy, let's just say the price hits this level and there's a lot of reasons why institutions should buy. The level, other factors I will teach you about, whatever. Well, there's going to be a very high probability of a bounce. Maybe not that we're going to start going up like this, but a bounce. After that, we can go lower or higher. Who gives a crap? We're already out. This is all we need, which we'll get into more detail later on. We're not at that part yet, but that's all we need. Now, this level was high value. This is a good buying level, not only because of what level it is, but look how long it's been since we've hit it. We haven't hit that level since 2023. So now there's more institutions looking at the stock. Maybe some just sold in the video or this or that. So if they see this, they're going to be like, okay, we'll actually buy it. If it hits. If it hits, they bought here, it goes up, maybe it goes back down. This amount of space doesn't give them enough time now, enough new institutions to even recognize or look at that level. So the probability of this actually going up is way, way, way less than it was over here. There's less buyers now. The ones who wanted to buy here already bought here. So who's still left? Maybe a very few. And that's why you'll see the more times a level is hit, the smaller the bounces get because you have less and less buyers. You'll notice that. And when a level is hit over and over and over, it's like, think of a door. If I keep hitting a locked door over and over and over, it gets weaker and it breaks. Same thing here. This level will get weaker and it'll break and the price can now go lower. Okay? Until the next major level where there's a lot of institutional interest, meaning a lot of institutions want to buy at the next level, then that will get a bounce. And if it hits over and over, it'll get weaker, weaker, and break. Okay? Now this is important because now you know that unless if a level just got hit and now it hit again right away, it's not worth buying at. It's only worth buying when there's a lot of liquidity there, and there's only a lot of liquidity when it hasn't been hit in a long time, right? And you're gonna have to practice with me. This is where practice is really important. The daily classes. Once you're finished this course, I will give you a million examples of everything and ingrain this into your DNA. I will literally ingrain this into your DNA. This stuff might be hard to understand or practice, but when you practice with me every single day, it's like anything. You can try to learn electrical. Are you going to be a good electrician if you just learn it on a book? Fuck no. Ask anyone who's ever done any construction. They don't learn shit until they see me do it until they see and do a million times, then they learn. Now, I recommend you guys practice this on your own, but practicing with me is extremely important because I will be able to identify your mistakes like that. I will be able to identify things that you will probably not be able to because you don't have that experience. And I know this because I've been in the same shoes. I've learned from institutional traders, and I only got good after seeing them do it over and over and over. This is not hard. This is very easy once it gets ingrained by a pro into your brain. It becomes very easy. Anyways, next thing we want to talk about is, so you guys understand now, if you want to buy at a level, you want to make sure there's liquidity. You know how to do that. Now, there's a breakout strategy people use to enter trades. Institutions rarely use breakouts, very rarely, depending on a bunch of circumstances, which we'll talk about later. They use breakout strategy. Now, when it comes to breakout strategy, you got to understand that, first of all, the more time a level has been hit, the weaker it gets. You guys understand this. So you can use that now. How do you use that? Well, this level got hit 1, 2, 3. There was a lot of liquidity here, but then it hasn't been hit for a long time. So now this is not a good time to look for a breakout. Even if you got a breakout here, you don't want to buy. This could easily be a fake out. There's a lot of sellers here. but people sold. They sold again. Now this is a very good time, decent time for a breakout here too. But the more times it's hit, the higher the probability of a breakout. Okay? So the less, and you don't want to short if it's hit multiple times. Now, if you get a breakout, this is very important. Once you get a breakout, there is going to be buying liquidity. Because what do people do when they see a breakout? Especially retail traders. Institutions, not that much. Institutions don't really care about breakouts that much, believe it or not. Under some circumstances they do. Majority of the times they do not give a solitary fuck about a breakout. It doesn't do anything. Okay? Well, what happens is a lot of retail traders buy on this breakout, thinking, oh, the price must go up now. Sometimes they even wait for their little confirmation. Oh, we broke above and we closed above that. So in case you guys don't know what I mean, let me just show you. Let's say there's a green candle, okay? So some retail traders, the ones that are noobs, who don't know much, what they do is they wait for a breakout. Hooray, we just broke above this level. We should buy now because we waited for the breakout. So it breaks here, they buy right away, and then the price goes down. Why? Because retail traders bought, and institutions, maybe they want the price to go higher, but they're saying fuck the retail traders first, and then we'll go up because they don't want them to make money. Then the price will go right back down because retail traders bought. And then there's some retail traders with this ego. Oh, I'm not a regular retail trader. I'm a smart retail trader. I'm going to wait for a confirmation like it matters. Because it doesn't. Confirmations don't matter. They're a very, very, very minor factor. And they're only even a little bit effective under certain circumstances, which we'll get into later. But what they do is, oh, I'm not going to wait for the breakout. I'm actually going to wait for the confirmation that comes after. So what they do is they wait for one more green candle. Boom. Close above the previous high. Now it has to go up because A, we got the breakout, and B, we got the confirmation. It has to go up now. I'm buying. I would rather just buy at the breakout, honestly, majority of the times. If I'm going to use this strategy, I won't even wait for the breakout. So the confirmation won't really do much, guys. That's what I'm trying to say. Institutions don't care. If there's enough retail buyers, they're going to push it down. Now, why does this matter and how do we use this? Well, if I see that something has been hit over and over and over, first of all, it's lost a lot of liquidity, a lot of selling liquidity, especially if the gap between these hits have decreased. Like, notice how big the gap was here. I would not buy over here even if we break above. No. But if it's been hit over and over recently, like 1, 2, 3, recently it's been hit over and over and over, now I'm like, okay, this level is getting weaker. Okay, I'm going to pay attention to it. Oh, it's gotten weaker and now we finally got the breakout. Cool. This could actually go up. But I'm not going to buy yet. No. I'm going to wait for this thing to... If it goes up, I miss out. Whatever. I don't care. I enter high probability trades. But what happens is sometimes it goes back down because institutions pushed it down to kick out the retail traders. And then what happens after, so retail's bought here. Oops. They bought over here, had their stop loss maybe here, take profit God knows where. Maybe up here, whatever, right? So institutions are like, let's screw them over. Boom. Okay, cool. Now let's go up. Now that they've been kicked out. Now, at this point, the second breakout, this is the first breakout, this is the second breakout. There's a way higher probability that now we go higher versus back down. Because the retail traders that bought over here are scared. They got wrecked here. They're less likely to buy here. And this is a real human psychology. You guys can look into it. Humans have evolved in a way that if we do something and it doesn't work out. Maybe I go into a cave, a particular cave. I got bit by a snake. It poisoned me. I almost died. I'm never going to go back to that cave again. We learn from our past mistakes. And our brains will literally produce cortisol. If your first experience doing something wasn't good, your brain will literally remember that and produce cortisol. There's a whole science thing behind it. And even if, let's just say there's a guy who went swimming for the first time ever. He didn't know how to swim. He didn't have a life jacket, and he almost drowned. Okay? Now, even with a life jacket, with someone helping him, he will be way less confident than he was before because past mistakes, right? So that's how the human brain thinks. And institutions take advantage of that. So, first time, they get wrecked. The second time, there's not going to be that many buyers here because retail buyers, because they're like, oh, we got screwed once. That's how they think, right? But this time it could actually be legit. Okay, so there's a way higher probability that if there's a second breakout, it's actually going to go up. And sometimes it still goes down. Okay, cool. Third one, even higher. The more times you get a breakout after a fake out, like this and this, your probability just goes up like crazy. Okay? Now, another thing is, you don't want to wait for first of all, you want to have your stop loss and you want to give it room. So even if you buy on the second or third breakout, maybe for some reason institutions still want to push more. Maybe there's some traders that are really good at trading and they know about this, so they bought here as well, right? They didn't buy here or here, and maybe in this scenario, very rarely, but maybe this is one of those scenarios where institutions are like, yo, let's just push it one more time. I think there's some smart people who learned from Sharoz and they know what they're doing, so let's push it one more time. Well, that's why, even if that happens, you have a backup. And that's not a tight stop loss. A lot of traders will enter a trade and have their stop loss right here and take profit God knows where, and they get kicked out before they can make any money. That's why you don't want to be greedy. You want to risk a little more, maybe put in less money, but focus on what makes technical sense. Give your stop loss enough room to breathe. And this is something you're gonna get better with in my daily classes. You have to join my daily classes if you want to learn how to trade and get good at this. If you want to make money and you don't want to learn, just copy my trades. Do whatever you need to do. There's many ways to make money without learning. But if you want to learn this and you want to get good at this, you will not be able to do that if you don't join my daily freaking classes. Don't worry about those yet. We'll talk about them later. Okay? The steps for my daily classes should be in the description of this video. Now, anyways, now what you want to do is you want to have a deeper stop loss. But that will mess up your risk to reward a little bit. Maybe you want to sell over here, but institutions can push it all the way down. So you want to have a deeper stop loss. Now, that's why confirmations are stupid. When you get a breakout, there's no reason to wait for a confirmation. Because look, if I get a breakout here, and I wait for a confirmation, which could be all the way up here, if we're lucky and not higher, but whatever, then I'm entering here. Look at my risk to reward. Went from 1.00, meaning I'm making $1 to lose $1. Now, I'm making 73 cents to lose $1. Not really good, right? And now I have to increase this, and maybe it's not below a major level. So confirmations are stupid. You should never look for them because the risk to reward will be screwed up so much that the confirmation and that increase of tiny bit in winning won't be worth it. That's why confirmations are stupid. Okay? Now, again, you guys have to join the daily classes and watch a million different examples if you want this to be ingrained in your DNA. I cannot... It's beyond important. Beyond freaking important. If you think you can just do it yourself after learning this, you're arrogant. That's not how I got good at this. That's not how anyone I know who's actually good at this got good at this. So, don't think you're any different unless you have the IQ of Elon Musk. And if you're watching me right now and you're learning how to day trade, rather than making sky ships, whatever he's doing, then you're not on his level. So, don't be arrogant. If you want to get good at this, you have to put your ego aside. The last thing you want to do is not become successful because of your ego. Think about how stupid you're going to look when you're 50 years old and you're like, damn, I could have become rich like all these other people who just ignored their ego, but I let my ego prevent me from making money and putting my kids in a better position. That is a slap to your freaking face. Like, come on. So put the ego aside. Anyways, like I was saying, we don't wait for confirmations, okay? And join the daily classes. Okay, I think you guys understand liquidity now. I know I went into it very deeply. I'm gonna start getting into rants probably in a lot of lessons because there's just so much to talk about, right? But now you understand liquidity. Now you understand if you're buying a stock, it's gonna have a higher probability of making you money and respecting your technicals if it's a bigger cap, right? Now, another thing you need to understand, which I forgot to explain, and this is related to liquidity. If you're buying something not based off of the charts, but based off of fundamentals, right? I'm talking about like earnings or whatever the hell, news, whatever. You got to understand, the bigger the market cap, the more of a waste of time that news or that earnings that you saw is. And I'll explain why. All the billionaires look at, we know, the big caps. Why do they look at the big caps? Because that's what they can actually put their money into, right? They can only put in like a few bucks into penny stocks or small caps, so they don't care. They want to find something they can actually buy, right? So all the billionaires are looking at the big caps first. The big caps, then the medium, like the large caps, then the big, then the medium, whatever, like that, right? So and these billionaires are the smartest people. They're billionaires for a reason. They're able to know where the price should be based on all these factors. So it's more competitive when you're doing fundamental analysis. So when you're doing fundamental analysis and you find something or a news comes out, it'll be priced in very quickly compared to a small cap. So if you want to be a fundamental trader where you use fundamentals and like technicals, it's going to benefit you way more to do this for the small caps. The smaller the market cap, the better. Okay? Because billionaires aren't looking at this random penny stock. So something happens, it's going to take longer for it to get priced in, depending on other factors too, but this is a major factor that you need to consider, okay? Yeah. That's why you'll see majority of personally, when I send out a trade based off of catalyst or research or any of that, look at this research over here, right? It's for small caps, penny stocks, because these compared to Nvidia is very well priced, and Nvidia, Tesla, Apple compared to small caps, okay? But anyways, that's going to be the end of this lesson. I'll see you guys in the next one. Watch this video a million times if you need to. And again, join my daily classes. And I promise you, if you do that, this will be ingrained into your DNA. And that's what you're going to have to do if you want to become a profitable trader. This isn't for everyone. That's why I have my trade alert service, where people can just copy me and get the same results as me. The only issue with that is, what if I die tomorrow? Now you're screwed. Now you're not going to have anyone to copy. Okay? Or you're going to have to find another person, which isn't easy. It's very, very difficult. Okay? Who knows? I might have a successor one day, but that's not guaranteed. Anyways, I'll see you guys in the next video. Bye. Okay, now we're going to talk about Fibonacci. And there's a lot of important things I want to talk about when it comes to Fibonacci. It's going to be another probably long video. So first of all, here's what my Fibonacci looks like. All orange. This one is red. This one is purple. If you double click on your Fibonacci, you get your Fibonacci from right here, by the way. Click on the arrow, Fibonacci. And then bam, bam, or bam, bam. Anyways, Here are my settings. If you guys want to copy them, forget about coordinates. This is just that's different. My settings are going to be over. They're all here on style. Yeah, exactly. This is all you need. So let's begin. Now, first thing I want to start off with is the 1 is not really a level. This is just where you connect. 0 is not a level either. Forget about that. Let me actually, yeah, just focus on these here. These are the Fibonacci levels that institutions use. And all of them are important. All of them are good. Now, the most important is the 618. It's known as the golden ratio. This is the most important. It's just more powerful than the rest. It's that simple. Just remember that. They're all powerful. This is just the most powerful. Okay, these are the brothers. This is Jacob, Jim, Moses, Abraham, and I don't know, Daniel. Okay? Whatever this guy's name was, he is the most powerful. He would win in a fight against all of them in a 1v1. And then the second strongest is the 382. Now, majority of the institutional traders I've met say that the 382 is the second most powerful. Some say they don't really know, they don't really care. They just know this one is the most powerful. They don't really care about second place that much. That stuff isn't even that important. Okay, I'm just getting this tiny detail out of the way. The 618 is the most important. They're all important. If there is a second most important, it's a 382. Personally, from my experience, I do think 382 is pretty more powerful than the rest, but it doesn't matter, okay? Now, how do we use the Fibonacci to enter trades? First of all, we don't use it alone. We don't typically use anything alone. We need multiple reasons and factors to buy. So let me explain this to you guys. The price can only go up or down. If you find a valid reason, not a bullshit reason, because there's a lot of bullshit reasons why people buy and sell, but if you find a valid reason for why the price should go up or down, and depending on how powerful that reason is, your probability of winning or losing is going to increase or decrease. But the more you have, the more reasons you have, the higher chances of you winning. So you want to have multiple reasons to enter a trade. I'm going to teach you how to use the Fibonacci in this video. So if we're buying, we want to, if we're buying something, maybe the price is going up. I don't want to buy up here. I want to wait for this to drop. So the price went up like this. Okay, So let's just say the price went up like this. I don't want to buy up here. I want to wait for it to drop and then I'll buy. Maybe I think it's really good to buy. The company's great. Everything is good, but I need a dip. Where do I buy? Well, that's what the Fibonacci's for. Once this starts to go down, what I want to do is get the Fibonacci and I want to connect this low right. So Fibonacci, connect this low right there to the highest point. And all of these levels will increase the probability that the price bounces. Does it guarantee that the Fibonacci will make you win the trade? Fuck no. Even if we have multiple reasons, not just the Fibonacci, even then there's no guarantee. The goal is to win more than you lose. But will this help you? Will this help your cause? Yes. Now, again, this is the second most powerful and this is the most powerful. The rest are still important. And I'm going to teach you how to do converging factors later. Don't worry about that, like how to converge everything. But basically, these are the levels you want to buy at, okay? These are the levels you want to look to enter at. Now, if you're trading on the big time frames, like something like maybe Tesla. Let's use Tesla as an example here. Let's use this here. Now, you want to look for buys if it's falling here, right? So what you want to do is you want to connect a major low. So you can see this is a major high, then this is a major low again here, and this is a major high. Now, as it's dipping, you want to look for buys. So as it's dipping, you want to look for buys. So we want to connect this low to this high. Hey, and notice it basically reversed off of that. basically. Okay, they came in a little earlier, but anyways, this one got respected, and then maybe I want to look to buy at the 618 next, maybe. Oh, notice how this level got hit 1, 2, 3, and then 4 times was the gap closed in, right? The gap between these two. So there's less liquidity and it broke below and went lower. Now, there's another level right there. And hey, it reversed again. This got respected. This got respected. And the 618 got hit. Price went through just a little bit, but let's see if it respects it. Got respected again. So these Fibonacci's are very powerful. Institutions do, and again, 786 slightly above, but got respected. Okay. And now these levels don't really matter. Now it doesn't matter if we hit it again. Only the first time it matters. So if the price goes back down here, well, it will still affect it, just like a level is still a factor, but it won't be as important. Just like how a level is hit over and over and over, it doesn't matter. Same with Fibonacci. Okay. Now, as it's falling here, what I could do is actually, let's go back in time a bit. I'm just trying to show you guys. As it's falling here, if I'm looking for trades, I'm going to be using this Fibonacci now. So connect and connect. And as it's falling, look, 382 respected again, right? 618, we pierced through, we didn't close above, and it went up a bit. Okay, and this one didn't get respected. But anyways, then this double bottom got respected as support. Anyway, so that's how you use Fibonacci when you buy. We're going to go into more detail soon. And if you want to sell, it's like this. So let's say, okay, the price is falling. Maybe I want to sell. Maybe I want to short if the price goes up or sell if it goes up. Where do I sell? Well, I could get the Fibonacci, connect the high this time to the low. Not low to high when you're buying. If you're selling, high to low. Write this down. And then if this goes up, I can look to short at this level or sell or here or here. These are factors now. Now, what if the price goes down like this and then starts going up? Well, now I have to readjust my tool and move this down here. Okay. Oh, but what if it doesn't really go up and it just misses and then goes up like that? Well, then I have to readjust again. So you have to constantly readjust until the low. And now this is going to be a level, this, whatever, right? So that's how you use the Fibonacci. It might take some practice and whatever, but that's how you use it. Now, some people, what they do with these, like, their own strategies that they have, they use something called order. What was it called? I wrote this down somewhere. Order block. Yeah, order block. It's probably the most garbage thing I've ever heard in my life. I've learned it once. It was complete garbage. Retails use it. You'll never see institutional traders talk about an order block. It doesn't exist. It's just some made-up thing. It exists, but it's just some made-up thing that has no substance. No substance. The Fibonacci is a mathematical tool, and the levels will change based off the high and the low. And this mathematical tool is found in nature. You can do some research on this tool. It's found in sunflower DNA. It's found in many other things. And this also works on the charts because institutions all use it. And they all use it the same way because it's very easy to use. The reason retail traders struggle with Fibonacci and they switch to other things that sound cooler like the order block is because they, first of all, don't know how to use it properly. They don't use it with converging factors, which we'll get into later. And number two, it's less effective on the smaller time frames, especially depending on what you're trading. So when they get screwed, they blame it on the tool, but they're the issue. Their lack of knowledge and experience is the issue. On the big time frames, you'll have institutions accumulating and taking profits from their investments. So buying as investments, accumulating at certain levels, and selling. And those selling and buying moves will cause a little bounce. It will cause a small move, and that's all we need. That's all we need to make money. Okay? Now, And that's why it's so much more powerful on the bigger time frames, because you have more institutions buying. On the small time frames, if a lot retail traders are buying there because of, again, liquidity. Remember the liquidity factor. So retail traders are buying on the small time frames. And if retail traders are buying on the small time frames, if anything, you want to do the opposite, because institutions are out there to get them. And if retail traders are doing it on the big time frames, even if institutions want to get the retail traders on the big time frames, it's going to be very hard, because they would have to move the price a lot. They would have to put in a lot of money and risk themselves getting screwed. Versus on the small time frames, just put in a little money and just move the price, So that's why the Fibonacci is extremely powerful, one of the most powerful institutional factors. Okay? It doesn't mean it's always going to work, but depending on how you use it, it has a very high probability of working. So this is a major low. Let's connect this to the highest point, and let's just see how this respected these levels. Wait, I'm tripping right now. I thought we were in replay mode. I meant to do this. So this is a pandemic low. This is the coronavirus low. Very important low. It's connected all the way to the highest point. Again, the coronavirus low. It did respect the 236 fib level. It did respect this level on the first hit, and that's what we really care about. Well, even here, on the first hit, it did respect it here. Let's go to the daily. Let's start from the really top. It just barely missed it, but this counts. So they still bought here. So this will have a less probability of bouncing. And you see how the bounce is smaller? Less buyers. That's what I was talking about. The more times the level is hit, the weaker it gets, the less of a probability it respects it, but also the smaller it's going to be. And then went down, it broke. And this move wasn't really caused by a level. This was just caused by, could have been news, could have been maybe a lot of people got bearish here, a lot of retail traders, so they had to push it up, right? Anyways, then the next level got respected again on the first hit. And the next level on the first hit, the 0.5 got respected again. Okay, so far every level got respected on the first hit. So far. 618, let's see. Next is a 618. We have to wait for this level. Remember, this is a stock like Tesla. What did I tell you about big market caps like Tesla? More big money is actually giving a crap about this company, so levels are more likely to get respected. And this is why people don't believe in support and resistance, is because they don't know where it works. They don't know when it works. And they don't know what it works more with. Like, there's so much they just don't know, right? If you're brand new and you're learning from me, you're thinking, wow, support and resistance, Fibonacci, no one can talk shit. But everyone talks shit. If you're not a beginner, you probably thought of me as like a complete idiot at the beginning, because you're like, support and resistance? You're a trend line trader? You're a support and resistance trader? Trash, you don't know anything. That's like beginner. No, it's not. It's the most powerful thing, one of the most powerful things. It's about how and when you use it. And you guys use it on the wrong thing. It's like, I could be the best basketball player in the world, but if I play soccer, I'm going to be shit. Right? My basketball skills, my height, all these ability skills I have only matter when it comes to basketball, not soccer. So you guys got to understand, it's the same thing here. Okay? It somewhat got respected, not a lot, but somewhat. And the 786, let's see if this level got respected. Yep, it did. So far, every level got respected on the first hit. That's the power of the Fibonacci. If I was trading something like no one's ever heard of, like, I don't know, a stock no one's heard of, it's going to be less likely. Now, I still trade stocks that no one's heard of. I do. But I'm more picky on them. And that's what I want to teach you next. That's what I'm going to explain to you guys. The less relevant a stock is, and the smaller the market cap, the less it's going to respect a level. It has pros, though, that it moves, maybe makes more money, whatever, but that doesn't really matter. What matters is how likely is a level to be respected. Now, the less relevant and the less market cap is on a stock, then what I do is I look for more reasons to buy. I'm going to be more picky. I'm going to judge everyone differently. It's like God. God judges people differently, or at least they say, right? Depending on, I don't know what your IQ level is or what your knowledge is. Maybe you don't know right from wrong. He's going to judge you. He's going to have mercy on you. At least that's what I was taught. But if you're smart, you know what's right and wrong, and you still do it, then you're going to get screwed. You're going to hell. You know what I mean? It's the same thing here. So he's taking it easier on, I guess, the less educated, the dummies, whatever. And he's going hard mode on some people because they have the knowledge. So same thing here. On some companies, on some assets, we have to be more picky versus a stock like Coca-Cola, Pepsi, even Tesla, Nvidia. These will respect levels more. Okay? So anyways, I don't know if that was a good example or not, but that's the best I could come up with. Okay, so that's the end of Fibonacci. I'll see you guys in the next one. Take care. Okay, so before we get into the strategy, there's certain information I want to bestow upon you. There's certain things I want to tell you. I even wrote them down in case I missed something. But there are certain knowledges that I want to give you guys right now, which I might have already in the previous videos, but I want to do it again because it won't hurt, and it's really important going into the strategy. So first of all, what do we trade and why? And how it's different from other people and why we do it this way. So first of all, we mostly trade stocks, but we do commodities as well, crypto, indices, futures, forex, even forex, which I'll talk about a little more in a second. But now we trade everything. Now majority of our trades will be stocks, majority, but we trade everything. Now, why do we trade everything? Because you'll notice other people, they say trade what you know. But they say trade what you know because they don't know how to trade, I'll be honest. Like, the thing is, we know everything equally. The reason we don't trade what we know and we trade everything is because the market is already extremely competitive. It's very hard to find an actual good trade. It's very hard. And that's why if you look at everything, you're going to have a higher probability of finding a good trade. Because if this doesn't have it, maybe this will. Maybe you go to what do you call it? How do I explain this? Maybe you're one of those guys that go to schools and find these prospects or something for basketball, and you're looking for like good players to hire for your NBA league or whatever. If you go to one school, what are the chances you're gonna find an NBA level player? Probably not that high. And when you're only going to one school, your brain is gonna be like, oh, we have to find it, otherwise we fail. So you're gonna force someone to join your league even if he's not qualified. You know what I mean? But when you're looking at everything, when you're trading everything, when you can go to a lot of schools, you have options. You're like, oh, this kid sucks. This whole school sucks. Everyone in this school sucks at ball. Screw them. I don't have to find anyone. I can just go to another school. Same with the stock market. Oh, there's no opportunity on this stock today? Cool. Next. This one? 50-50. No, I don't care. Next. Because you have options. The more options you have, the better. The more pickier you can be and still find a trade. But when you have one thing, you're either going to not enter trades or you're going to force one. And it's going to be a losing trade. So it's really important that you trade, that you're willing to trade anything that presents a high probability setup. And I've met many traders, regular traders. I'm not going to name them, but the famous ones. Some of them got famous for crying, by the way, if you know what I'm talking about. But it doesn't matter. Point is, I've met a lot of traders. I know a lot of traders that got famous, not in real life, but like online. I've seen the way they teach, what they teach. The ones that got famous for the way they look, the way they act, not really for trading. Those guys will almost always only trade one thing or tell you to only trade what you know, but that's not right. Because every institutional trader I've ever met, the ones that went to uni, the ones that trade for banks and hedge funds, they all tell you they all do the opposite. They literally look at everything. because they know if they only trade one thing, they're probably going to enter one trade a year. Or they're going to enter a million trades or more than one trades, but they're not going to be good trades. They're going to be 50% winners, meaning you have 50% chance of winning. So you're going to lose all your money over time to the spread and fees. And by the way, when you don't have a high win rate, even if it's a 55% win rate, if it's not 70, 80% like me and other institutional traders, you're a human being, you will get emotional. But when you have institutional factors and you know how to use them and you're a really good trader, you're entering a few trades but they're very high win rate, it's going to be very hard to get emotional. Okay, the reason people get emotional as traders is because their win rate sucks. I would be emotional too if I had a 55% chance of winning. That is mayhem. But when you're entering 4 trades and you're winning 3 of them, it's going to be very easy to stay calm and not get greedy because you know that you're probably going to win the next one and it just doesn't end up affecting you that much. So that's really important too. You want to look for high win rates, low quantity, meaning less trades but very high win rate. Okay? And the only way you want to increase your quantity of trades is by spending more time looking for more trades. That's it. But you shouldn't be entering a lot of trades. Your goal is to enter a few, but high win rate. And that's going to be best for your psychology as well. Okay, another thing I want to teach you guys now. Next thing is why looking at too many time frames can be really bad, but why people do it and why it sounds like a smart idea. Sure, it sounds smart, right? Oh, I want to trade Tesla. I want to day trade Tesla, but let me look at the bigger time frames to figure out what's going on. And then let me go to the smaller time frames and look for what the bigger time frames favor. Like if the bigger time frames are bullish, I'll go on to the smaller time frames and look for buys. Makes sense, right? Doesn't work out that well. Now, some scenarios, it will help you. But the thing is, knowing a trend and whether a trend will continue or not is very difficult. If you've studied a stock very well or an asset very well and you think it's extremely undervalued and that until it hits a certain level it should be in an uptrend, then yeah, that could work. But the thing is, the more different time frames you look at, the more distracted you get. And we're not robots. We're not able, it's very difficult for us humans to look at so many different time frames and remember, oh, on this time frame is bullish, this one is bearish, but this one is bullish, so I should be, you're not going to be able to remember. It's not going to work, you know? The best way I find is looking at one time frame and entering trades on that. So maybe I see a trade on the small time frames, I'm going to enter a trade there. If I see a trade on the big time frames, I'm going to enter a trade there. I'm not going to use the small for the big or the big for the small. Now there are a few cases where looking at different time frames will help you. Absolutely. There are a few. I've done that, but it's very rare and I wouldn't recommend you do it unless you really know what you're doing. Some people, what they do is they trade the small time frames, but they go to the big time frames and they say, I have to know if it's bullish or bearish. And now they're forcing a bias. Unless it's clearly obvious that it's 100% bullish, it's going to be a distraction. It's going to mess you up when you do trade on the smaller time frames. So what you want to do is you only want to use higher time frames for smaller time frames as a bias when you're very, very, very certain. Otherwise, it's going to be a distraction. It's going to mess you up. It's going to get in the way. It's not going to help you. You can't force something to help you. You only let it help you when it wants to help you. Okay? That's what I'm trying to say. So that's really important. You don't need the big time frames. You don't need multiple time frames. That's a bonus and only works in certain circumstances, which we'll learn about later, especially in the daily classes, because I need to show you guys a million examples of all of this stuff for it to really be ingrained into your brain and DNA properly. Okay, another thing I want to say is the smaller the time frame, the harder it is going to be to trade, because on the smaller time frames, you have robots trading. Okay, and robots' main purpose is to chase liquidity, and they can actually do it because they're robots. We can't. Okay, I'm not saying it's not possible to trade on the smaller time frames. I've done it and I've made money, but it is so difficult. And certain things, even I can't make money on. Like, I can't trade Forex on the smaller time frames. I can't. I will not be profitable. And Again, I've learned institutional factors from institutional traders. I've surpassed them all by miles, genuinely. And I am humble enough, and I'm just going to be honest, like, I can't make money. I won't be profitable. Not even a 51% win rate with everything I know, because when it comes to certain things on small time frames, like Forex in particular, it's being moved by random things happening in the world. It's not moving like a company that is moving because of something happened in the company. No, it's some random stuff which even robots probably like have a hard time calculating. Like, you can't compete with that. Okay? But on the bigger time frames, it's easier because you're aiming to enter trades where institutions will accumulate for a bounce, and that's all you need. So bigger the time frames, the easier it is. I do trade small time frames, certain stocks, and there's a way to do it. You guys will learn about it later on in this course, okay? Now, yeah, so that's why the bigger the time frame, the better, especially as a beginner. Okay? And it also, there's a spread fee. And this will affect you less if you're looking for bigger moves and bigger time frames. So even for spread and fees, it's also very important, okay? Next, I want to talk about why Forex sucks. And again, it's because I just told you 2 seconds ago, it's moving because of random factors, and levels don't get respected. Institutions aren't looking to buy currency pairs that much. Like, they don't really care. They're looking to buy assets. Currency pairs are not assets, so they don't care about levels. So there's no substance. Do you understand? They're going to buy stock, Tesla, at this key level because it's Tesla. They want to buy this freaking company so they can make money. Why the fuck would they want to buy the euro dollar at a key level of support unless they're going to Europe or whatever? Why would they want to buy the Canadian dollar just because it's a major level of support when it's not an asset? They're only going to buy the Canadian dollar if they go to Canada. You know what I mean? Now, I'm not saying these levels don't work, but they work way too little. Like, it's very hard to be profitable. And again, some people look at me like I'm crazy. Like, what? Are you saying Forex is bad? It's the biggest market. Yeah, it is the biggest market, but biggest doesn't mean best. Like, I don't know. Like, I have a phone over here, and if I have another phone that's 1,000,000 times bigger, does it mean it's better? Didn't phones get smaller and lighter over time? And they're still better, and there's a reason why we have smaller, lighter, and they're better. Like, there's a reason why phones got that way. If bigger meant better, then our phones would have gotten bigger over time. Think about how smaller phones are nowadays. And they work just fine. Bigger does not mean better. Okay? We don't care about So here's the thing. Yeah, it has more money. It has more liquidity. But that's not going to matter to you anyways because you're not trading with billions and billions of dollars. That's first of all. Second, there's no substance. Levels will not work because there's no reason for them to work. On Tesla, there is. The level will work because it's a major level and institutions want to buy this asset. They don't care about the euro currency or the Canadian currency. They don't care about that. Not even the only times they care is if they're like, okay, let's hold cash, guys, because what if the market drops a lot? It's good that we have cash available. Cool. Which cash is the best to hold? Is it the euro dollar? Is it the Canadian dollar? If we're going to hold a currency, might as well hold the one that has the most upside, least downside. That's the only time they care. And that is too small of a factor to affect the price enough to the point where you can trade, especially in the smaller time frames. So there's no substance behind any strategy on the smaller time frames. That's the issue. Now, there is one way to make money on Forex, but you're only going to enter like 1 to maybe 5 trades a year if you're lucky. And these are going to be good trades. 1 to 5 in a year is the most you'll be able to enter with this one strategy, which I will teach you later. And it is on the bigger time frames, by the way. And this does work. But again, only 1 to 5 trades. Not on the small time frames big. If you're trading on the small time frames, I don't even know what you're doing. You know, if you go to any institution like a hedge fund, a bank, and you want to trade for them, this is a fact. If one of the first things they ask you is, what do you trade? If you say Forex, they don't even hear you out. They tell you to get the fuck out of here. They really do. That is not an exaggeration. They really do tell you to get the fuck out of here if they hear Forex. get the fuck out. That's what they say. Like, they don't care. They don't even want to. They're not even open to maybe you are profitable. Maybe you're 1 in a million. They don't care. It's not worth their time. They kick you out. So that's why I'm saying what you trade is very important. Okay, another thing I want to say, accumulation, before we get into the strategy, is we are buying everything we use. Fibonacci, levels, parallel channels, indicators, anything, moving averages. We use these, or anything I will teach you, we use these to figure out where institutions are entering, accumulating. Again, institutions don't have one level where they buy. They don't have one level where they sell for their long-term investments, even for their swing trading, but especially they're more long-term because they have too much money for trading. But anyways, point is, we're entering where they want to accumulate. And that's why we trade on the bigger time frames more. Now, once we enter a trade, it doesn't matter if it's the bottom, if it continues to make new highs. We don't care about that. We're in, we get that bounce of a certain size, which I'll teach you later, and we're out. We don't care if it goes higher or lower. We don't care. We're just using institutions' money. We're basically taking money from institutions. Okay? That's not that we're competing with them. We're just using them, if that makes sense. If we know they're going to buy here because it's a key level, and we're very certain, and the price is going to at least bounce from their buying, regardless of whether it continues higher or goes down, we don't care. It's going to at least bounce. They're going to buy at least a little bit. We can buy just like at that level, so then they can push the price up and we sell. Okay? That's basically what we're doing. That's what you got to remember in your head. This is going to go a long way. Okay? This is going to, because every decision you make is going to be based on this reason. And remember, what institutions buy, why they're buying it, what factors affect their decisions. I've taught you a lot of this stuff. If you have to go back, and you're going to continue to learn more as I actually do it. Okay? There's certain things that I will probably never teach you guys in this course, not because I don't want to, not because I'm gatekeeping, because I won't be able to remember to teach it to you. Like, there's some small things that affect certain things in certain scenarios, which I can only teach you when I see an example, if that makes sense. You know what I mean? I can only teach you to do certain things when I have to do it, and those scenarios only come in certain times. That's why you have to, just like I learned from institutional traders by doing it a million times over, it has to be the same way. You have to join the daily classes, okay? Okay, now there are some rules that you guys need to know for the strategy. I'm going to tell you guys the rules and why these rules exist, okay? So, for example, I wrote these down. Now, the first and most important rule is when we buy at a level for whatever reason, maybe there's a million reasons to buy and it's a stock like Nvidia, Tesla, where there's a lot of institutional interest, whatever. That's great and all. But you don't want to buy at the level depending on how it's hit. So let me explain what I mean. If this is the level, maybe Tesla's at whatever, $500 or Nvidia's at $500, we want to buy at this level right here at $100 because there's multiple levels. Every reason you can imagine is there, okay? This is a great spot to buy. Now, if the price falls to it naturally, meaning institutions are taking profits, selling, and I'll show you how to identify this very soon. If that's what it's caused by, then it's a great level to buy. Great trade. But these levels will not work or will have a way less probability of working if something is being priced in. I'll give you an example. Maybe the price is here and you want to buy here, and the price does hit this level, but it's because earnings was bad. Maybe it was very bad and the price drops. Now that's something being priced in. Okay? So that is still buying at a discount here, but it's not the same type of discount. When something is discounted for no reason versus when something is discounted for a reason is two different things. If I sell you my phone I give you a 50% discount when it's brand new, you're gonna be like, holy shit, 50% discount for a brand new phone? Hell yeah. But if it's used up and if I already used it, have scratches on it, now you're still buying it at a discount, but there's a reason you're buying it at a discount. You know what I mean? Same thing with stocks. If it falls into it naturally because institutions are taking profits, they want to buy something else, whatever the reason is, then yeah, that's a great opportunity. When something's being priced in earnings or maybe tariffs or maybe a war or anything like that, there's a reason it's falling, so you're not really getting a discount even though you are getting a discount. It's not really a discount. You know what I mean? So this is a very important rule. I hope you guys understand. There's some scenarios where I still buy anyways, very few, and that's what practice is for. And I have to show you on every different example because it's different. So for you to get the hang of it, it's really important. Again, you join the daily classes. I cannot stress this enough. If you want to learn this, you have to join the daily classes. Otherwise, you'll become profitable at 99 years old when you have a few years left to live. Okay, another thing is, if you're buying maybe a technology stock because it's at a good discount, great. But here's something you want to avoid. When the whole sector of this maybe let's say there's the 100 technology stocks, or let's just go into the beverages stocks like Pepsi, Coca-Cola, food, McDonald's, Wendy's, anything you can imagine that's related to food. If only one stock falls and is at a good discount, that's a great buy. It's at a great level, it's a good buy. But if they're all falling, guess what? It won't be as good of a buy. And I'll tell you why. In this sector of food stocks, if one stock is low at a discount, every institution is going to be like, oh wow, look at this, it's pretty cheap, let's buy it. Right? Now, if the whole sector is down, guess what? They have so many options where they're like, okay, we have all these things we can buy. Which one do we buy first of all? Which ones, I guess, and how much money do we put in? So the reason why this matters is because if there's only one stock that's down, every institution is just going to buy that. There's nothing else to buy. So the probability of a bounce is higher, and it's even more. But when a whole sector drops, now they have so many options to pick from, they might not even pick the stock you're buying at that level. And if they're not buying that stock, and even if they are buying it, who's to say the buy will cause your take profit to be hit? They buy here, so you bought over here, and the price does go up because they buy. But maybe it doesn't hit your take profit, and then it goes back down and goes lower after. Maybe it barely misses. This scenario is more likely to happen when they're not buying one stock, when they're buying like so many because there's so many discounts. They're gonna, instead of putting $100 into this one stock, they're gonna divide it up into this. So the bounce will be smaller on the stocks individually since there's less money going in, and that gives you a less probability of your take profit level being hit. So what do we do in scenarios when the stock you're buying, the whole sector is at a discount? Well, you have to be extra picky. More factors, better levels. Versus maybe out of all this sector, only one stock is at a discount. You don't need that many factors or that many discounts, especially if it was a natural sell-off, meaning institutions sold, something didn't get priced in. It's just they took profits to buy something else, okay? Hey guys, so this is the FinViz tool. This is where I find stocks. This is the main way I find stocks. There's other ways to find stocks too, but this is the main way. FinViz. Now, before I teach you how to use a FinViz, let's go on home. And this is, I told you if one stock falls within a sector, it could be a better buy versus if all of them fall. Well, you could also use this to figure out what sectors are doing and individual stocks in their sectors. You can click here and check the 1 day performance, 1 month. So maybe in the past month, this whole sector went up, but AVGO went down and it's a big cap, then I would want to definitely look into that. Okay. Google went up 25%, Meta's down 3% this month. Maybe Meta needs to catch up now. So if you look at Google, if you look at Google, let's see, it's all the way up here, Meta, down here, and it's a bull flag pattern. If it hits support, this could be a good buy. So that's just one example, right? You have a bull flag pattern, factor one. You have, let's delete these lines, by the way. You have factor one is bull flag, factor two is this support level, factor three, we can even, factor three is going to be here. It's parallel to resistance. Factor four could be that maybe it converges here with this level if it falls. So that's four factors, right? 1, 2, and maybe it's also Fibonacci sequence. It's not. Okay, whatever. But the factor that Google is up and then Meta is down in the sector, same sector here, that's another, reason why I can be less conservative and be more ballsy because of a knowledge institutional factor, whatever you want to call it, like this here. So that's how you use FinViz, like the sector thing. I forget what this is called. But yeah, the map. It's called the map. Anyways, if you go to the screener here, right there, you can play around with this, whatever you're looking for in terms of descriptive. Maybe you want a large market cap, $10 to $200 billion company. Technicals, maybe they have to be 10% below, 20% above. You can play around with this and figure out what you want. I like to typically just go for market caps. I look at large, mega, large, mid, small, and micro. I look at these ones. I don't look at the rest. And I do technicals, typically 30 oversold. 30 oversold. Because now these companies are falling. I can start looking for levels that are good buying opportunities. That's how I like to do it. Okay? That's how I use FinViz. You can play around with it. You'll see me doing a bunch of different things with this in the daily classes when we use FinViz, okay? So that's it. Next, I'm going to teach you guys the Forex strategy. So let's get into that right now. Okay, let me teach you guys now the Forex strategy. Okay, so first of all, again, I don't really trade Forex. If I do enter trades on Forex, which I'm open to, it'll be like 1 to 3 trades a year. That's it. Maybe a little more on a good year. Could be a lot less, could be 0 on a bad year. And the way I trade it is a little bit, even the ending part of it is a little bit different. So, where do I even begin? So, first of all, how do regular people trade Forex? Euro USD. I'm not going to get into why I will not trade on the small time frames. I think you already know that much. If you don't, you should seriously restart this course. But you should know why the small time frames are not good, especially for Forex. I trade small time frames, some other things, but not Forex. Now, even if they're trading on the big time frame, they're just going to look at this chart and enter a trade. That's not what I do. I look at the euro individually and the US dollar individually. So the US dollar is the DXY, the euro dollar is the EXY. So look, EXY, the euro dollar index, DXY, the US dollar index. That's the gist of it. But before we even get into that, first thing we gotta understand, we don't care about the EXY, the euro dollar. We don't care about the CXY, the Canadian dollar. We don't care about the BXY, the British dollar. We don't give a shit about anything when it comes to this strategy. We only care about, right now, the DXY. That's the first thing we care about. This is the universal fiat currency, so we only give a shit about this. Now, here's how it works. In case you don't know, I'm going to tell you something right now that is true, which is that when the DXY goes up, rest of the dollars go down. When DXY is going down, then rest of the dollars are going up. Why this happens is not important, but I'll tell you. People are either taking money out of the dollar, the US dollar, to put it into other fiat, or they're putting it into the dollar and it's coming out of fiat. So now there's rare circumstances where the dollar is going up and the euro dollar will also go up. Rare circumstances if something is being priced in, but typically it's the opposite. So the US dollar is very special. It'll always or almost always do the exact opposite of everything else. They all move together against the dollar. Now, this information is going to come in handy later. So the first thing we do is look at the dollar. Okay, and by the way, you don't even need to watch this video if you don't care to enter maybe 1 or 2 extra trades a year. But if you're open to it, then yeah, you want to learn this. Now that we know this, and I'll give you an example. Like, look at the dollar here. Let's go to the daily time frame. Sure. Let's go to the daily time frame. Let's look over here on the daily time frame at the EXY. Okay, look. The dollar is falling here. The euro went up. It's literally always doing the opposite. You can go test it yourself. Literally always. Same with the CXY, everything. If you don't believe me, you can go check yourself. It literally always does the opposite, or almost always, like 99% of the time, opposite. Hold on. Okay. Sorry about that. Anyways, so now the way we trade this forex strategy is first we look at the DXY. Okay, now if the DXY is at a key level of support, for example, I'll give you an example right now actually. Boom, there's your resistance here. Resistance. You drag this down to the very bottom point right there. You have pivot, pivot. If the price drops, that's a key level of support on the daily time frame. Maybe institutions will convert their euro currencies into this currency because if they want to hold cash, might as well hold the cash at a discount, right? So that's why this will have a little bit of an effect. So if it hits here, that's a key level of support, right? Or imagine it also converges with this level here. Right there. That's 2 levels. Imagine it's also a major Fibonacci sequence. Oh wow, it kind of is. Almost 0.5. This still counts in my books. Notice how the 618 is converging with that though. That's nice too. Anyways, we have a Fibonacci sequence here. So let's delete this. We know this is the Fibonacci. So that's 3 factors. We have these 2 levels and we have the Fibonacci. Let's write this down. 0.5 Fib. Let's write this down. So that's 3 factors and they're major on the big time frames. Okay, cool. This is a good spot for the dollar to gain value. Okay. If the dollar drops here, I can bet in value and try to make money. Now, there's 2 ways to actually enter a trade now. If you want to do it through the stock market, you can just buy an inverse ETF that goes up when the dollar goes up. I don't remember what ETF that is. You can search it up on ChatGPT. I'll just do it right now. What inverse ETF goes up when DXY goes up. Right? There you go. You can buy this or whatever. So through the stock market, you can buy the US dollar. So there's some inverse ETFs that are tripled, meaning if the dollar goes up 1%, you make 3%, like stuff like that. But these inverse ETFs are only meant for trading. They're not meant for investing long term because they deteriorate over time. Imagine paying interest, but like crazy numbers. So you don't want to hold them long term. Okay, let's look at that ETF actually, UUP. Okay, well, some don't always go to zero, but a lot of them do and they deteriorate. So point is, or I don't even know if this is the, yeah, this is not even the right one. Yeah, I don't know, but the point is, you have to find it. I haven't entered a trade on it a long time ago, so I'm having a hard time finding it, but I'm pretty sure this is not it. Anyways, oh no, USD index, yeah. But anyways, the point is you can buy an inverse ETF that goes up when the dollar goes up. That's a sick way to make money. Now, if you're a Forex trader, you're going to need a Forex broker. Okay, if you want to trade like Euro USD. And if you are a Forex trader, here's what you can do. Now that you know the dollar is going to go up, you want to bet in favor of the dollar over here. Great. But what do you want to bet against with it? So there's Euro USD. There's USD CAD. So USD, what's the other one going to be? Well, what you want to do, if this is down here, all the other dollars are going to be at a high price. So you want to look at all of them, the EXY. You want to look at the ZXY, the New Zealand dollar, the Canadian dollar. You want to look at all the other indexes. So you already know you want to buy the dollar here. You want to bet in favor of it. Now all these other dollars are going to go down, but which one has the best probability of going down? So you look at the CXY, EXY, ZXY, you look at all of them. And the ones that have the best resistance levels, the best Fibonacci convergence, the best technical factors to why it should go down, that's the one you use. So maybe that's the EXY out of all the other dollars. So then EXY you combine with the US dollar, that is Euro USD. Okay, now you're gonna enter a trade here. Okay, so let's delete this. So once all those things happen on the US dollar and the EXY, okay, you want to enter a trade on Euro USD, but you didn't even look at the chart of Euro USD. You looked at everything but Euro USD. This is the least important chart you want to look at. Least important. Okay? So notice how when this goes down, the Euro USD goes up. Okay. So if this is gonna, so it's the opposite, right? So if you think the dollar is gonna go up, you want to bet in value, and you chose Euro to bet against, now you have two different charts to why this should go in your direction rather than just one. That's the benefit of trading Forex pairs, but it's a very small benefit. Like, I wouldn't want to switch to another Forex broker just for that. I'd rather just look at the dollar, enter trades based off of that, using an inverse ETF through the stock market. You can trade Forex through the stock market. That's how I prefer, and I guess, yeah, that's how I would do it. I hope you guys understand the strategy, and I hope you can see why this works. If you don't understand why this works, you need to watch the whole thing again, because if this doesn't click in your brain like, holy crap, this is a sick idea, then you don't understand it, and you want to watch this video again. Okay? And again, the daily classes, I can't stress them enough. Every day you get to ask me questions. Every day other people ask questions. I answer them, you learn something. It's just non-stop learning, polishing, getting better and better and better and better. And without these classes, I can see someone learning all of this after a lifetime, and even then not learning even 70% of what I know. If you want to learn 100% of what I know, you have to join the daily classes. That is literally the only way. I'm telling you guys right now. They all get recorded too, in case you miss it. The daily classes are going to be very important. The daily classes are just one part of what you get with the blueprint. So the blueprint is going to have literally, it's going to have a lot more information or a lot more examples. But the most important thing, you guys already learned a majority of what I'm going to teach anyways. There's just going to be a few more powerful factors which you'll learn about. But the point is, the classes are beyond important. You will literally be as good as me within, if you join every class and practice every day, I say about 2 to 6 months, depending on how much effort you put in. 2 months is possible. And once that's done, you can literally make money from anywhere in the world without having to rely on me. And that's why you want to learn this. Because what if I die tomorrow? You never know. Hope for the best, prepare for the worst. Especially if you've copied my trades and you're addicted to making effortless money just from copying, you know you don't ever want to lose this. You know you don't want to take the risk of one day me not sending these trades. You want to be self-reliant, you want to be self-dependent, and that's why I made this course, because I know a lot of people think like that. I personally thought like that when I was learning from institutional traders and just copying them and making a crap ton of money. I thought like that, like, okay, that's great, but what if he stops sending out alerts, or what if he dies tomorrow? So I know you guys probably think the same way, or at least some of you, and this is who this course is for. This is who these daily classes are for. And yeah. Okay guys, so you've made it till the end of the course. First of all, congratulations for making it this far. Again, first of all, most people won't even make it this far. They'll start it and then quit because maybe they saw something else, a new strategy or a new business or a new mentor. They saw someone with a Lamborghini. God knows, people are very that's what people do. That's what majority of people do, and that's why majority of people don't become successful. It's because they want to try out something new every day, and they never stick to one thing long enough to see if it actually works or not. There's some people that do that actually, but it ends up not working out anyways because they didn't pick the right thing or the right mentor, because there are scammers out there. There is information out there that won't help you. Not that this matters, but I don't want to get into it. Point is, you guys are already the top 1% because you've actually completed this course. One of the reasons why a majority of people fail is because they never really try. They don't even finish the freaking video of this course. So, and not just this course, but other courses too. It's a real stat. Majority of people that start will not complete it. It's already top 1%. For that, congratulations. I already see a mini version of me in you, because you're clearly dedicated enough to finish this course at least, and that does mean something. Now, for those of you that are serious, I do have a blueprint where I teach a few more factors. They're extremely powerful, and I don't want to teach it to everyone simply because they're too powerful, and I want to get paid if I'm going to give it out for free, if I'm going to give it out. Okay? Now, with everything I taught you, you can make money. You should be profitable now, especially if you practice or disciplined, and you should be profitable. But there's certain factors, there's only a few, like 1 or 2, that I haven't taught you because they're too powerful. I want to save those for the people that do sign up for the blueprint. And number 2 is the most important thing, actually, the daily classes that come with the blueprint. So we have the few factors, and the daily classes, and I cannot stress the daily classes enough. Whether you have those few powerful extra factors or not, the daily classes are life-changing, because you only learn something when you do it. Again, I've used this example before. If you're a construction worker, you don't really learn construction through a book. Ask anyone that does construction who went to school for it. They will all tell you they learned how to trade, whatever trade they do, like construction, whatever. They learned it when they freaking did it. And I also want to start a hedge fund in the future, meaning trading for billionaires and millionaires. And when we make the money, we keep a cut. And for that, I want to have a team. Once my team is large enough, I probably won't even do these daily classes or any of that. I probably won't even teach institutional factors. It wouldn't make any sense for me. But that's a long time from now. God knows when that's going to be. Now, you don't have to learn these institutional factors and learn how to trade and then trade with me and then with my hedge fund. You don't have to help out or receive help. You can do whatever the hell you want. But there are some of you that want to be a part of something bigger. Thought I'd let you guys know about this. I want to start a hedge fund with profitable traders who work together, help each other find trades. Like it's like hunting. If I get something, we all eat. You get something, we all eat. It doesn't affect us, right? It only helps us. We all make more money from each other's hard work. And again, the hedge fund would be a part of it. Us starting a hedge fund together and trading for billionaires and millionaires and all of that. Now, in these daily classes, you will also learn how to invest in detail, where to accumulate, why, all of that when it comes to investing and achieving high returns through investing. People think, oh, investing is slow, you make a little bit of money. No, that's if you do it the traditional way. You can make very good ROIs, very good numbers from investing long term or for a few years or for 1 or 2 years. Very high ROIs if you know what you're doing and you know where to accumulate and where to take profits and how to rebalance, which is one of the most important things. So that's another thing you'll be learning in these daily classes every single day, trading and investing, learning, as well as you'll have the most up-to-date recent insights on what I'm doing, and you'll be up to date with the market as well. So it's not just learning, but it's also being up to date with what's going on and all of that. Now, the thing is, when you're entering trades, when you're trading, when you're doing all this, sometimes you'll enter a bad trade, but what will happen is you'll get lucky and you'll win, and that's terrible. Typically, when you do something and you do it wrong, you don't get good results, which is a good thing because now you learn, and now you learn not to do this next time. But when you enter a bad trade, you can still get unlucky and win the trade on the back test or in real time, and you'll never know you made a mistake, and you'll continue doing it. Sometimes you enter a really good trade, best trade ever. It loses, but you think you made a mistake when you didn't. So next time, now you're looking for mistakes, and I'm telling you right now, there's a reason why a lot of people do this and they don't learn anything. They just keep losing and losing money because they don't know where they're messing up. And that's why having a mentor is really, really, really important. One that, number one, is profitable and has proven it to you by you copying him for a year and you knowing he's profitable. If you're watching this video, maybe you already copy my trades. But anyways, the point is, these daily classes are going to be the difference maker of whether you're actually able to use this knowledge or not. Any knowledge in trading is useless unless you know how to use it, and you have to use it slightly differently in different scenarios. Like, for example, you want to buy at a level, but if it's something being priced in, you don't. But maybe in some scenarios you do because of this and that. So that's why these classes are very, very, very important. We go through a million charts, not a million, but literally dozens and dozens every single day. And that's why this knowledge and the skill will literally get ingrained into your DNA. Now, one of the reasons I'm charging for this blueprint is because I don't think it should be free, and I want to make money from it. Another reason is because, as you all know, finding good trades is not that easy. Like, you have to look at a lot of different charts to actually find a trade. That's why I look at so many different things. That's why I preach to you that to also look at as many things as possible, enter a trade when you find a high probability setup. Well, I want to build a team that all works together, and whoever finds a high probability setup, we trust each other enough to just enter the trade without having to do any of the work. So if you find a trade, I make money. If I find a trade, you make more money. We all make money. We all work together. So once again, congratulations for making it this far. You're already the top 1%. Now, if you want to sign up for this blueprint, we have to know if it's even right for you because our classes are at a particular time. Okay? Particular time, and these timings could change depending on where you live and a few other factors, this might not even be right for you. So if you want to sign up for this blueprint, use the link in my description, in the description of this video, or the steps should be here on, and then use the link to set up an appointment with us, okay, with me or someone from my team. Once you set up an appointment with us, we'll actually figure out if this is even right for you and what your next move should be, like what we can actually do to even help you. We don't even know if we can help you yet or not, because the classes are a particular time, and we have one-on-one options. We do one-on-ones as well for people that don't have time. So we really got to figure all of this out, because if we're going to do this, we want to do this right. We want to make sure by the end of this blueprint that you sign up for, that you're actually profitable and that you're actually able to get the most out of it. So set up an appointment with us so that we can actually figure out what would be best for you. Okay. With that being said, I'll see you guys later. I wish you guys the best.